Let's bring in George Ball. He is Sanders Morris Harris CEO. George, it's good to talk to you. So I guess the other question would be, do we even need another catalyst, or is it just enough that we'll see stocks drift higher because we've got the Fed underpinning things, we've got a lot of cash in the system? What do you think in terms of the next move upward?
Well, Julia, as you say, the market is gasping and grasping for some new leadership signal. Vaccines, virus, stimulus spending are all rather well priced into the market. People have different expectations, but they're pretty much there as knowns in the marketplace. I think the next move, especially if you're a trader, is probably greed. And there's a greed catalyst out there that I think is very influential.
George, so if the greed is the next element here, I mean, that to me sounds like we could see another 10, 15, 20% move in the markets over the next few months.
We could. B, I'm actually talking, don't usually do this, about the shorter term element. And it is the greed of a Wall Street trader who gets paid his or her bonus based on results at year end. In 75% of the years in which the markets were higher at the end of November, they went up further in December. Now, part of that you can say is the Santa Claus rally theory, but Virginia may be right, and there is a Santa Claus, but it doesn't exist on Wall Street. The fact is that people who get paid a percentage of the profits that they make, generally at the end of the year, will often buy more of the same stocks or bonds in the month of December to protect that bonus element. Now, they're not doing anything wrongful. They're buying the things that they like the best, but there's a very strong bias to see prices higher in December when the year has been up so far. Now, is that a 20% move? No, but if you look beyond it, there are some other very positive catalysts for the market, I think, that aren't priced there yet.
And George, I'd love to get your thoughts on what some of those catalysts might be, because we have seen a lot of enthusiasm, particularly around the vaccine and what 2021 might look like here in the U.S., hopefully a lot more normal than 2020 was. That feels like it's being priced in today. What catalysts are you looking at as we get towards next year?
Probably three that are very influential and that aren't there. By there, I mean priced into the market yet. One is that there's going to be a good deal of spending, and it's likely to be in infrastructure first and before anything else, but that's going to be a major economic stimulus for the markets. And infrastructure is something where Republicans and Democrats can broadly agree. The second factor that isn't there yet is an intangible, and that it is the evidence that President-elect Biden is using unification as his primary theme. Unification is good for psychology. Look back to the President Reagan era, where he made people feel good. And I think that's a second major factor that isn't there in the marketplace yet. And the third is that people, and particularly the younger do-it-yourselfers, the Robinhood traders, are discovering individual equities as a place of interest. Part of it speculative, part of it interest, and they're a bigger and bigger factor in the market and tend to be on the bull side as opposed to the contrary. So three big pluses that aren't priced into the market yet that could easily push the S&P over 4,000 sometime before mid-year next year.
George, you mentioned sentiment, and I do want to ask you what you're hearing from clients, particularly because I think it's valuable to hear from people who are outside of Wall Street, physically in a different geographic area. You're down in Houston. And so I'm curious what you are hearing on that front, and in particular, wealthy clients who may be happy about that unification theme you were talking about, but maybe not so happy, anticipating an increase in their taxes. Is that something you're worried about? And is that affecting the positioning in the market?
All of life is after tax. And higher taxes will impact the wealthy. They'll impact stocks. They'll impact higher housing prices. They impact everything. So on a relative basis, although taxes will go up, and that's not good for people who want to keep more of what they've earned. It's not apt to be a major deterrent out of stocks into other value sets.
Of course, we've been talking about the vaccine news that has hit this morning. Both the fact that the Pfizer-BioNTech coronavirus vaccine is now begun to be administered in the UK, and the full release of the documents associated with that vaccine, the FDA saying that they confirm it is safe and effective. What effect is all of this going to have on the broader markets? Let's bring in Jeff Kleintop. He is Charles Schwab, Chief Global Investment Strategist. Jeff, it's always good to see you. How are you thinking about vaccine rollout? As we were talking about earlier in the show, some strategists are looking at the potential and saying maybe there's even more upside than we are predicting if things go off sort of without a hitch.
Well, that's the key, if they go off without a hitch. And we can talk about some of those potential hitches. But I think the real bright spot, if you look at the upside of the economy and earnings next year, isn't really in the S&P 500. We may be looking in the wrong place. It's overseas. When we take a look at where the real potential for an earnings rebound is, it's really concentrated in Europe. When you take a look at the numbers, Wall Street analysts are revising their numbers higher. They're doing most of that in Europe. You're looking at numbers 35, 40, 45%, in some cases 60% year-over-year earnings growth in countries like France and Germany. So that's great news. Their valuations are also quite a bit lower, but you combine that with more room for profit margin expansion, maybe leadership by financials, which is the biggest sector for the EFI index, and in Europe, a weaker dollar boosting returns measured in dollars. And then you've also started to see international outperformance here in the fourth quarter. And technically that actually began back at the end of April, where we started to see this new cycle begin. I think this cycle is going to be much more about international than US stocks, something that could catch a lot of investors by surprise.
Jeff, before we touch upon that, you did write in your recent note, you expect a near-term double dip. I assume that's the economy double dipping. What would that mean to the market?
Yeah, well, it depends how long it lasts and how deep it goes. And that's why I think we're seeing a little bit of softness today. We've got this period from now until we see mass immunizations in the spring, if everything goes well. And that means we're in lockdowns 2.0 in a number of states and a number of countries. That could turn into lockdowns 3.0. We just don't know what the economic damage is. These lockdowns seem to be less stringent than those put in place back in the spring, in terms of manufacturers generally being left open, schools generally being open, but that could change. And so we've got to keep a very close track in terms of how effective these lockdowns are in containing the breakout of COVID until we get to those mass immunizations. Again, double dip in the data is almost assured in December for some countries like France, for example. But could we see more in the first quarter? Yeah, I don't know. And that means maybe a more volatile period here before we really start to see those gains kick in, perhaps in the second half of next year.
You know, Jeff, as you look at 2021 and the earnings picture there, the numbers are going to be quite good, but you know how this works, right? If they're not better than expected, well, then the market's going to interpret them as not as good. How much risk, I guess, is a lot of this great news, whether it's with the vaccine or, again, corporate results, call it Q2, Q3 2021. How much of a risk is that becomes a sell the news type of period?
That is a real risk. The market has priced in a lot of this recovery already. So I'm looking for areas where still valuations are left leaving enough margin that maybe they don't need to surprise by much in order to get a lot of a move there. And that's where I'm seeing more value-oriented sectors, areas that really haven't participated in much of this move in the market. Oh, maybe they have in November and early December, but really from, let's say, May to November, most value sectors, and I'm talking about industrials and financials, energy materials, really haven't done a whole lot. I think there's more room for the upside there. And again, those are sectors more heavily weighted in international benchmarks.
Well, we can't let you go without getting your take on Bitcoin here as it hovers near record highs. Any outlook for crypto space as it becomes more institutionally oriented?
Yeah, we'll have to see. I mean, it's interesting that there's more and more adoption I'm seeing as I'm doing my holiday shopping. Maybe more retailers accepting Bitcoin as payment. So that's some sense that there's increasing acceptance there. But we'll have to see. I'm actually disappointed about blockchain. We really haven't seen a lot of developments there, adopting that as a new technology across, let's say, healthcare records in this very challenging period of time. And maybe that says something about the long-term viability of cryptocurrencies. But I'm not an expert.
All right, Jeff, thanks for coming on. Talk to you soon. Jeff Kleintop is Charles Schwab Chief Global Investment Strategist. Appreciate it.
Investopedia has been surveying its readers throughout the pandemic to get a pulse of investor sentiment and behavior. Joining me now to talk about the findings is Investopedia's editor-in-chief, Caleb Silver. Caleb, always good to see you. I know you're fresh off wrapping this latest survey, and I'm curious if your readers have great expectations for 2021.
Way to drop the Charles Dickens reference in there, and absolutely. 77% of them, Alexis, think that the markets will be higher in 2021. About 20% of them think they're going to be 10% or higher. So very bullish, and they've been bullish since we've been surveying. I've spoken to you several times over the past 6 months. This is the 7th survey we've done. We did this one right after the vaccine news started dropping in November, and the bullishness is at an extreme level, not only with our readers, but also with the American Association of Institutional Investors, also with big money, big institutional investors. So the bullishness and the sentiment is very strong, and it's that vaccine news that's opening up people's optimism and thinking that we're going to get higher highs in the places where we've been getting them for the past 6-7 months.
So do they believe that U.S. equities are going to lead the advance in 2021? Where do they see most of that strength coming from?
Sure. It's a lot of home cooking, and these are U.S. investors, and they think the returns are going to continue to be in the U.S. Even though other emerging markets in China have been outperforming over the past several months, they think the U.S. is going to have higher returns, and they think it's coming in big tech, they think it's coming in pharma and healthcare, and they think a lot of that is paved the way because of the election, but also the vaccine news. But with the election out of the way and what they think will be sort of a gridlock Congress, they are expecting higher taxes, but not right away. So they think it'll be a continuation of the same elements that have brought this rally from April to today, higher highs, record highs today. They think it's going to be a continuation of that going forward, and they're bullish.
I hope we're seeing a little bit of a healthy dose of pessimism here, right? Because things can't go up, up, up forever. What are they telling you, your readers, about possible headwinds for the market next year, or things they believe could trip up the recovery?
Sure. It's COVID. It's the resurgence of the virus. It's been that all along. Ahead of the election, it was the election, and then the aftermath. The concerns about social unrest after the election were heavy on their minds, and they were not as bullish in October. But as soon as we sort of cleared 3-4 days past the election and the outcomes started to come together a little bit more, they've been worried about the resurgence of the virus, but very bullish on stocks and buying hand over fist, as you've seen with institutional money. Institutional money, Alexis, as you know, was out of the stock market from April till about October. And then we saw record inflows week after week. Individual investors, our readers, and also those surveyed by the AAII are also very bullish and buying stocks right now. Higher highs usually beget higher highs, but as you know, this could be a contrarian indicator. When everybody rushes into a crowded trade, usually the bottom falls out eventually, big money leaves, and the herd follows after. I'm not saying it's going to happen this time, but that's always the risk.
Well, speaking of which, you look at tech stocks, they're back in vogue in a big way right now. We had seen that move out of growth into value for a while. Looks like it's moving back the other way. Do you see that rotation happening in a meaningful way, Caleb? And do you think it can continue well into Q1?
Yeah, I do. And it's this ping pong effect. You see it on the daily basis. When the vaccine news is good, you see the cyclical sectors, the value sectors rally, the banks, energy, transportation rally. When it's bad, when it's uncertain, and we have mounting cases and daily records for viruses and deaths, you see that trade going back to the safety trade, which is funny because it's growth, shouldn't be safety, but that's where the money's been all year. So it's this ping pong back and forth. But within the other part of the cyclical trade, when we see value stocks rise, we've also seen the defensive sector, not defense stocks, but the defensive stocks, those with dividend-paying stocks, tried and true. A lot of our readers are 55 and older. They revert back to those stocks. So it's this kind of rotation within the rotation, and then the extremes of extreme fear, I'm going back to tech and gold, or extreme confidence, I'm going to play the value sector rally, and I'm going to play the metals.
I'm curious if they gave you any feedback, your readers, on the idea of stimulus. Are they concerned we're not going to get another stimulus relief package, or are they banking on the fact that we will get one and that's what's going to help lead us higher in the new year?
Great question. It's not stimulus per se, it's government spending. They know government spending's coming because of the Biden administration, because we potentially have this gridlock in Congress. We'll see after those runoff votes. But also, Janet Yellen, if she's the Treasury Secretary and she gets appointed and confirmed, she's a monetary policy dove. There will be more spending. Spending, low interest rates, and relatively low inflation is a good recipe for stocks. It has been for the past 4 years. It probably will be for the next 4 years, too, absent a black swan event like the one we've just had.
You got some smart, thoughtful readers there, Caleb. Caleb Silver, editor-in-chief of Investopedia. Thanks so much for being with us.
Let's bring in Josh Jamner. He is ClearBridge Investments investment strategy analyst. Josh, just give me the lay of the land right now, how you're viewing some of the market moves as we look to the last several weeks of the year. On the one hand, we've got Washington still in limbo. Nothing really changed over the last few months. And on the other hand, we've also got more and more restrictions coming through as we see the spread of this virus.
Yeah, we think that the economy is continuing to recover. We certainly think that we're going through a little bit of a softer patch in terms of the pace of that recovery. But when we take a step back, we use what we call our ClearBridge Recovery Dashboard. It's 9 economic and financial market indicators that we use to keep tabs on the health of the economy coming out of a recession. We think the recession ended all the way back May or June, kind of middle of this year. And there's really actually been no change over the last 3 or 4 months. It's been continued slow but steady improvement. As you said, we've been waiting on D.C. for a stimulus bill for quite some time now. It's not an even recovery. There's been some fits and starts, good and bad. As you just said, there's a little bit tighter restrictions with relation to coronavirus over the last couple of weeks. But taking a step back, things like housing continues to be really strong. NHAB, a home building sentiment index, all-time highs last month. Housing starts continue to look pretty healthy. So while we're not off to the races, we continue to see steady progress forward, and hopefully that'll continue as we move into 2021.
Josh, this week we're going to get a couple big IPOs here, first with DoorDash, then Airbnb. But when we look at kind of the valuations there, I think some larger market trends, it might be able to be teased out when we look at the valuations there, since Airbnb kind of saw a V-shaped move in their own valuations. And I wonder how much of that in your mind is tied to expansion when we think about how people are valuing these companies that survived, not only survived, but thrived in the post-pandemic world as we started to reopen. What does that maybe say about the risk reward for some of these more cyclical stocks that maybe had been beaten down when you look at cruises, airlines? What's your thinking around that?
So I think there's a couple dynamics at play. The first is when you think about the market as a whole, valuations are going to be higher just given what's in the market today. As you mentioned, cyclical stocks have been beaten down. They're contributing less earnings. They're also a smaller share. They're actually at one of their smallest shares, the overall benchmark, in about 100 years. They tend to trade at cheaper valuations. On the other side, you've got the defensives. You've got some more of the more growthy type of companies that you were just mentioning. They're at their largest percentage of the benchmark going back, 50, 75, almost 100 years. And that just a natural outcome of that. You've got more high PE stocks in the benchmark, fewer low PE stocks in the benchmark. Think about energy and financials. They tend to trade below the market. They're at probably 5-6% less of a weight. Tech, by contrast, tends to trade expensive. It's about 10% more weight in the benchmark today. And that's just pushing up benchmark valuations for valuations for the benchmark as a whole. If you were to kind of neutralize and say, well, what is kind of a typical weight? PE on the S&P would be 1.5, maybe 2 turns lower today.
Josh, I want to get back to what you said earlier about how you believe the recovery is still intact. Not a lot has changed, at least in your view, since the summer. And yet I have to wonder how much of your portfolio is priced in what's actually been playing out right now with additional restrictions being reimposed. We've seen the labor market, the recovery on that front start to stall as well. I mean, is this most recent wave, you think, not too disruptive, or you think that a lot of these businesses that have already been struggling could still ride out the wave? I'm trying to understand why you think this is still a very strong recovery, even in the face of not being able to have controlled the virus and the vaccine. The expectation here that it's not really coming to market until the spring next year in terms of a larger scale.
So a couple things are at play. First is that consumers have built up a ton of savings. Savings on an aggregate national basis are almost $1 trillion higher today than they were right before coronavirus hit. If you go back to kind of the end of last year, they're in excess of $1 trillion higher. So, me, you, everyone out there, whether it was a function of people receiving stimulus checks, government transfer payments, or the inability to spend, or people just deciding to keep a little bit more cash in the bank, whatever the sources were, people have a little bit more of a buffer. And even though doesn't seem likely that we're going to have, vaccines tomorrow, hopefully it'll be coming through late first quarter, early second quarter on a more widespread basis. There's a greater buffer there because of that buildup in savings that can allow the economy to kind of keep plodding ahead. It might not be spectacular, but I think it'll prevent us from going into a double dip scenario.
Yeah, you're our second guest today that stressed the savings rate there. Clearly an important thing for investors to keep their eyes on. Josh Jamner, Clearbridge Investments investment strategy analyst. Appreciate you coming on here to chat that.
Thank you.
80% of CFOs say the stock market is overvalued. That's according to Deloitte's quarterly survey of Fortune 500 executives out today. Joining me now to talk about it is Steve Gallucci. He is head of Deloitte's North American CFO program. Steve, always good to see you. So look, 80% of CFOs say the equity markets are overvalued. So what is their expectation for the stock market in 2021? Do they see that valuation pulling back in a big way?
Well, we didn't see that they would be pulling back in a big way. This is a trend that we saw in our third quarter survey, where roughly the same percentage of CFOs that we polled indicated that they thought the stock market was overvalued. Interestingly enough, they feel like the stock market will continue to stay at its levels, probably maybe increase a bit. But over time, I think there's an expectation that the market, if you will, the stock market will align with the real economy.
Did they talk at all about how their views about the stock market may impact business decisions? For instance, how they might look at merger and acquisition opportunities?
Well, not specific to the stock market, but we did ask some questions about whether or not the companies would continue to seek business opportunities in terms of M&A and capital spending. And by all indications, they said the trend would continue. And that really ties to the overall theme of our report, that CFOs are generally optimistic about 2021. Certainly a bit uneven by sector. Those sectors that were hit relatively hard during the pandemic will take a longer time to get out of where they are today. But for the most part, across the board, we saw 70% of our CFOs were generally optimistic about what 2021 looks like, mostly on the back half of 2021.
What about their biggest concerns or worries heading into the new year?
Yeah, I think the biggest concern that everybody has right now continues to be the pandemic and how quickly the vaccine can be distributed, and what impact that would have on the markets. Going in, when we look back at our last couple of surveys, a number of variables that CFOs who generally don't like to eliminate variables in their analysis we're dealing with. Obviously, how could their company respond to the pandemic? What was going to happen with the election, and how long would the pandemic last? Obviously, the election, it being clearer now, and with a vaccine on the horizon, that really is what we think driving these optimistic numbers that we're seeing in our survey.
What about when these CFOs look at their internal budgets? When do they think things might go back to some kind of normal or maybe pre-pandemic levels?
Yeah, again, it's split. There are some CFOs, about 18%, will actually reach pre-pandemic levels in 2020, but a third, for the most part, they will actually reach there in the back half of 2021, and some also into 2022. And again, that gets back to those sectors like retail and services that were hit the hardest. They're having a more challenging time currently.
When I was looking through this survey, I was a little surprised to see that most of these CFOs are more bullish about China's economy and the recovery there than they are here at home. Can you talk a little bit more about that?
Yeah, interesting enough, that was a trend that we saw again develop in the third quarter survey. It's the first time in the 10-year plus history that we've been doing the survey that we saw an outlook that was more bullish in China versus North America, specifically the United States. And really, when you step back and look at that, really, again, tied to the pandemic and tied to the ability of the China economy to, first off, it hit first, obviously, in China, but secondly, when you look at how China has dealt with the pandemic, it's caused the economy, obviously, to emerge at a quicker pace. So that really is driving those numbers both in the last quarter and certainly continuing into this quarter.
And look, we have a new administration coming into the White House next year. What did the CFOs tell you about what their wish list is for the new administration? What are they optimistic about?
Yeah, well, it being the holiday season, there's really three things that we saw on CFO's wish list. First and foremost, 3/4 of CFOs said that there should be a significant investment in infrastructure. In addition to that, about 62% believe that there should be a stimulus package, maybe not something as large on scale as the CARES Act, but something more targeted. And then lastly, also about 3/4 of the CFOs indicated that they would like to see a national strategy for responding to COVID-19. Those were really the top of the wish list, if you will, that we saw from this survey.
All right, we're going to leave it there. Always insightful to get the results of this survey. Steve Gallucci, head of Deloitte's North American CFO program. Be well.
Thank you, Alexis.
Let's bring in Jack Ablin. He is over at Crescent Capital, the chief investment officer there. And Jack, let's begin with something you bring up in your note, which is investor sentiment has really gotten, hot, overworked, however you want to call it, in the last couple of months. I mean, everything has come up positive on the vaccine front. Stocks are flying, left and right, up 10% every day. How concerned are you about this environment as we head into 2021, a year that I think for humanity is likely to be a lot better, but for financial markets may present a few challenges?
Yeah, thanks, Miles. Yeah, I think it is a concern, at least for the near term. The market is certainly forward-looking. We understand that, and everyone's focused on the second half of next year, which will certainly be great. But between now and then, we're still facing a pandemic. Our third wave that started in October is now 3 times worse than the waves that we endured in March and in June. And we're starting to see some of the fallout from that. In fact, a number of the entire increase in initial jobless claims this morning was from pandemic-related unemployment. So clearly, there are going to be some issues. And then when you have expectations, sentiment so high and expectations so high, we have to keep in mind that the market is simply a reflection of reality versus expectations. And when expectations are very high, the possibility of disappointment is high also.
Well, Jack, it's Julie here. It's good to see you. Let's talk about an area where expectations appear to be very high, and that's in the IPO market. And let's not even get into SPACs and all of the activity we've seen there. DoorDash, Airbnb, C3 yesterday, .ai is another one that was bid up. What do you make of all of this enthusiasm specifically for the IPOs and some of these hot SPACs as well?
Yeah, I mean, I think it's still, it is leveraging on this investor enthusiasm. Keep in mind that most of the move that we saw earlier this year to the upside was fueled by retail investors. And then once the vaccines were announced a little more than a month ago, institutional investors piled in. So when you do look at cash on institutional portfolios, they were pretty high going into that November run-up. So I do think that investment bankers are certainly watching Yahoo Finance, and they're watching a lot of the headlines, and they're saying, geez, with the market up 12% in November, now's a pretty good time to bring private companies into the public market.
Jack, do you think 2021 will be the year of disappointment for investors? And we were just talking about Disney. The stock's up 80% from the March lows. The company has just lost nearly $3 billion in its last fiscal year. It seems completely detached from any forward-looking reality that might form on the bottom line for this company over the next 12 to 18 months.
Yeah, I don't know if it's going to be hugely disappointing, because I do think, we will get business back to normal, at least in the second half of the year. But, it's astounding to me that if you compare Amazon to Royal Caribbean Cruise Lines, at least from March, Royal Caribbean Cruise Lines has doubled the return of Amazon over that time period. So clearly the market is looking forward to life returning to normal. But, have we really discounted the best case scenario? That's quite possible. And we're going to find out in the first half of next year.
Jack, I just want to finish up with something that you just referenced, which I think is maybe an under-discussed story, which is the role retail has played in the 2020 market. Kind of came out of nowhere. All of a sudden, everyone wanted a brokerage account. Everyone was playing the market. We haven't seen that in quite some time. Do you think that this is a new trend, or is it, like all retail fads, something that's likely to fade in the years ahead?
Well, I think, Miles, a lot of it really depends on, how they're doing. The fact is that retail investors certainly got in early, and they've benefited. So I think that, and maybe the skeptical side of me said, well, no sports were on, so they couldn't bet on sports, so let's bet on stocks. But the fact is that those bets have worked out. So my sense is we will see retail investors in the market as long as they keep making money. There's no reason for them to get out. If we see a big pullback, that could shake some of them loose. But generally, they're gonna keep at it until it doesn't work anymore.
Jack, I always loved that thesis on the sports betting, because sports came back on and then everyone realized they kept losing at the same rate. And so the stock market was maybe that was more fun in the first place. The Vegas always has that extra half point that never seems to come through on a Sunday afternoon. Yeah, all right.
That's it.
Yeah, they're pros. There's a reason they're the house, and we're just a bunch of Joe Publics. All right, Jack Ablin is the Chief Investment Officer at Crescent Capital. Jack, always great to get your thoughts. Talk soon.
Thanks.
What other stocks, when you talk about finding high quality equities, what are the variables that make an equity, in your opinion, high quality? Some people, I would imagine, would say the dividend yield. What is it you look at?
So for us, we look at multiple layers of quality, and the foundation for us is always strong free cash flow, because we know that when a company has free cash flow, that they tend to have organic growth, corporate earnings. They're easier to manipulate. We also look at balance sheets, and then we take it one step further, and we're looking for other high quality moats that give a company a sustainable advantage.
What mistakes have people made in this easy money environment of the last roughly year by ignoring free cash flow? Do you think we're going to see some burst bubbles in the new year because of that?
I think we have to investors will have to be careful. In the short term, we do have stretched valuations, particularly in some of the work from home or work from anywhere names. At the same time, we've had a big rally in the Russell 2000, and a large percentage of those companies are not profitable. And I think at some point the market is going to differentiate between companies that do have cash and companies that are profitable. So we think as we have this shift from the thriving defensive companies to the recovery, more cyclical type companies, that you want to make sure you don't get surprised with the bankruptcy, that you firmly own high quality companies within that cyclical space.
Janet Flanders Johnston is the co-CIO and portfolio manager at Trim Tabs Asset Management. Thank you for your insight.
Before we get to the deal, I do want to ask you about your economic outlook, given the expected vaccine rollout, because I know you're looking for a dip in economic activity in the fourth quarter. As we start to see more broad distribution of the vaccine, what then happens beginning next year?
Well, we see next year a growth level overall through the entire year of about 5% after a down 4% this year. But there probably will be a slight shift from our original forecast. This recent surge in COVID cases will probably slow down growth in the first quarter. But we think that as the vaccine starts rolling out, that this will provide a surge of growth in the second, third, and fourth quarters next year. The one factor which we're still looking at quite closely relates to stimulus. Will Congress come back with a stimulus program that will allow people, especially SMEs, to make it through the next quarter? This is going to be a tough quarter with the COVID, with the lapse of the stimulus programs. So the stimulus program and vaccines, those are two very critical factors to see what's going to happen with economic growth.
Doug, Brian here. When I saw this deal cross the wires, the $44 billion deal for IHS, I immediately thought, you know what? Doug is making a play. He is saying data is the new oil. Would you agree with that?
Well, data is definitely what people are looking at. And the way that data becomes the oil is when you can actually use it. And this is one of the beauties of our ability to merge with IHS Markit. And that is that not only do we have the data, the content, the research, the benchmarks, we also have the data science teams and analytical teams that can turn that data into usable products that get embedded in people's workflow.
And, Doug, thinking about that, and I think about our audience here at Yahoo Finance, tends to be more of a retail-oriented audience, and they've seen the tools that are available to them on the public and free side increase over the last, 10, 15 years. From your end, on the proprietary side, the data that you guys have access to, the indexes that you can build, how much has the financial data market changed in the last 10 years, and where do you see that heading over the next 10?
Well, we think about, if you talk about the last 10 years, let's think about what it's going to look like 10 years from now, both for a consumer retail audience as well as for institutional investors, institutional customers. The world is changing. The way people use AI, visualization. Think about the use case of somebody who's an index investor. Today, we have the S&P 500 and the Dow Jones. Those are part of our company. And we're going to bring in fixed income indices as part of our portfolio with IHS Markit. When you can start putting those together in new ways to have multi-asset class indices, when you can think about retirement, the baby boomers who are going to start retiring, there's going to be a whole new set of tools that people can use for asset class allocation, for ways to think about their own retirement, their own portfolios. And this will also apply to institutional investors as well. And the same way we looked at the index business, we're going to have the same opportunities with ESG, with energy transition, with the way that debt capital markets put together the information we have from the credit markets, the risk modeling, and then the workflow tools that IHS Markit has.
So as you're looking at that deal and all of the data that you guys compile collectively, the two companies, what's in the highest demand? What do your clients want to know the most about right now?
What we're seeing is that obviously when our clients are looking at opportunities where they see that we do things together, our investors are looking at opportunities for us to put the businesses together and get scale. Scale is something that's so important for us, that's going to deliver the growth. It's going to deliver the opportunities to find savings as we put together our data, as we manage a technology across this entire portfolio. And very importantly, that scale is going to give us as well a very large cash flow, free cash flow, and just within a couple of years of over $5 billion. And we believe that we can continue to invest $1 billion a year in technology and still generate $5 billion of free cash flow.
Doug, the consensus on the street appears to be that you have some pretty sizable opportunities in structured finance and then in ratings in China. What are your plans in each of those areas next year?
Yeah, structured finance is something that obviously goes in and out depending on interest rates, on how people are thinking about their balance sheets. We see right now the mortgage market, the retail mortgage market has been quite active. There's probably opportunities for that to start becoming more securitization. With interest rates low, a lot of banks and other organizations have been continuing to keep their assets on their balance sheet that they might traditionally put into structured finance vehicles. But we see the opportunity for us with IHS Markit to have the reference data along with the ratings data, along with the research in a new way to provide services to our clients. clients. China for us is a very important market. We see the Chinese regulators committed to reform, committed to opening up the Chinese market to foreign investors. Right now, there's only about 3% of the Chinese bonds are owned by foreign investors. And the Chinese regulators are interested in seeing new ways to open up their market, bring in more foreign capital. We've seen recently that other large financial institutions have 100% operations in China. We've been there now for over a year with a rating agency 100% owned, and we're seeing a steady interest and growth in that interest in our ratings and our methodology, which is bringing a global methodology and a global approach to credit ratings to the Chinese market. So as the Chinese market reforms, as you get institutional investors, the middle class starts having savings that they want for the long term, we think that this will be a growth market for us in the long run.
Well, speaking of another growth market, I want to touch on something that you brought up, which is ESG, which I know that you have been talking about for some years now. We on the show have talked a lot about sort of the seeming gap still between ESG desires and reality on the ground. And so maybe you can talk to us a little bit about that gap and whether it is indeed being closed and how much closer we are to, particularly on the environmental side, I would say, but on the social and governance sides as well, how much some of these long-awaited changes are actually starting to be implemented.
Yeah, the ESG is going to become a very critical factor for investors to make decisions about their portfolios. The question that's been coming up from investors, whether it's retail investors that are asset owners or it's institutional investors, increasingly in the United States, it started in Europe and moved into Asia, but increasingly in the United States is, where are the funds that I have being invested? What is the impact, environmental or climate impact, the social impact? What's the quality of the governance of the organizations I'm investing in? And we see an increasing demand for people to have the right kind of data, the analytics, the disclosure that will allow them to make an informed decision. And we've been doing two things. One is we built a portfolio of products and services through acquisitions and also through our own growth to build information about climate, about ratings, about how it goes into credit. And with IHS Markit, we also are going to bring in now a whole new set of data about carbon registries, about metals that are used in batteries, about electric vehicles and the way they're performing. And putting this together will give us the ability to provide a much broader set of data and analytics to those that are interested in ESG. The second thing I'd say is that as a company, we believe that we need to operate at the highest standards of ESG ourselves if we're going to be a credible ESG data provider. So we've ensured that we have strong governance. We have diversity at our board. We're ensuring that we have the best social practices. This year during COVID, we started with our philosophy that we put our people first. We've been investing in health and mental health programs for our employees so they have what they need to work from home. We've also invested in technology to work from home. And then when it comes to the climate, we have an ESG report. We've reported through a framework that's called the Task Force for Climate-Related Financial Disclosure, which we think is very important for our company to have started to model that directly and show how you can disclose and can be a leader in disclosure, because we think disclosure is so important for ESG, but we can bring it together and then provide the data and the analytics and the tools that people can make informed decisions.
Doug, just a couple more weeks in the year. What has this year been like for you as a leader at your company? But also, too, when you talk to your friends, let's say on the business roundtable, what are you hearing from them? How has the year been like for them, and what are some of their plans for next year?
Yeah, the business roundtable, as you know, we have a very active board of directors that has been talking about the external environment. A little bit over a year ago, we discussed the change in the purpose of a corporation, which was a very important shift for us. But this wasn't just a shift from one day to the other. It's something that we've been doing for years. And if you think about that shift from a single purpose of a corporation to shareholders, to talking about the other stakeholders, which are employees, our suppliers, our communities, our customers, we've been doing that for a long time. And it's not an and, it's an or. I mean, it's not an or, it's an and. It's providing value for all of those constituencies. But when we talk about going forward, we're looking at very important topics. We're looking at racial equity. We're looking at how we can ensure that there's immigration reform, about infrastructure. We're looking at climate. We're looking at ESG, all of the themes that investors, our employees, our communities are talking about. The Business Roundtable on its own is looking at these to see how we can help support a transition that's taking place in our economy, as well as to support the new administration.
Well, looking forward to continuing the conversation about all of these issues and finding out also that transparency, that data issue about these things is also very important. Doug Peterson, it's always good to get some time with you, S&P Global President and CEO. Thank you.
We're joined by Simon Freakley. He is the CEO at Alex Partners. Simon, thanks so much for joining the program today. I want to begin with a recent report that you guys put out looking at the restaurant space and some of the pressures that we're seeing there. And I think this number is right. It was quite alarming to me. Some 63% of full-service restaurants are now distressed businesses. What is the plan there? What are the prospects like there for this space? As we all want the world to get back to normal, but that is a tremendous blow to that sector of the economy.
Miles, thanks for including me this morning. Obviously, 2020 has been an extraordinary disruption. And not to say, of course, that industries weren't being profoundly disrupted before the pandemic came along. But as you say, the restaurant space has been hit very, very hard. And of course, to state the obvious, the problem for the restaurant business is if you don't sell a meal or a drink today, it's not as if someone's going to buy 2 meals and 2 drinks tomorrow. So those revenue dollars are lost forever every day that these places are shut or compromised. So the restaurant sector, the hospitality sector, but more broadly, Miles, the consumer goods sector, the retail sectors have been profoundly disrupted. Have there been winners and losers? Yes, there have. Have people that have pivoted into strategies in the restaurant business, for instance, to say curbside pickup or delivery, have they done well? Yes, they have. But my goodness, there have been winners and losers.
Simon, Brian here. What are you telling the CEOs of these restaurant companies and these even retailers? What strategies could they employ to come out of this the other side? Probably much smaller, granted, but even just the fact that they could stay in business would probably be a big win for many companies.
Well, Brian, of course, the key as with every situation like this is agility, moving to action, having a clear strategy, and more importantly, executing that strategy. And so take a business like Uber, for instance. I mean, the classic Uber is down massively during the pandemic, but Uber Eats is up over 150%. So it's not as if people in the hospitality space can't find strategies that work. Many restaurants in metropolitan areas have moved to curbside pickup and much more efficient delivery mechanisms. They've found that as a strategy to cope. But those operators who haven't been fleet of foot, who haven't had a strategy, who haven't moved to action to execute it, have indeed been left behind. There'll be profound disruption in retail and hospitality, but also in retail. But, we look at retail, for instance, there have been, again, real winners. So you look at the hyper-local delivery aspect of Walmart, for instance, their ability to service people's urgent needs on a very local basis has actually driven their business, a business that had pretty much no online strategy 3 or 4 years ago, now the biggest online or second biggest online retailer in the US after Amazon. So it's not as if there aren't successful strategies, but in talking to the clients that we have every day, it's a matter of being proactive, having that strategy, more importantly, executing it with focus and pace that's keeping them on the front foot.
There's one area, Simon, it's Julie here. There's one area that's sort of the knock-on effect from some of these retail struggles that I don't know how you can strategize out of, and that has to do with real estate and the mall owners. Right. If their tenants are struggling, if their tenants are closing down, I mean, what do you do with that empty space? How do they navigate through this?
Julie, you're absolutely right. So if you look at the traditional department stores, for instance, the Macy's, the Lord & Taylor, the Neiman Marcus, they've really struggled because of the closure of the stores, episodic closure, but also the drastic reduction in footfall. Same for the mall business. And even the discount operators, the JCPenney's, the Kohl's, have been suffering for the same reason. And so the winners in the retail sector are those people that have had a viable omni-channel strategy. Having an omni-channel strategy in itself is not the whole solution, because of course, even if revenues have been maintained through a swing to online, the cost of fulfilling an online order is much greater than the cost of selling an item in a bricks and mortar store. So whilst some of the retailers that have omni-channel strategies have seen revenues maintained, they've seen operating margins reduce. But you put your finger on a very important point, Julie, which is those people who are heavily reliant on bricks and mortar stores have a real challenge. Now, some, for instance, like Primark, have made a virtue of the fact they've had no online strategy. And whilst they've been closed during periods of lockdown, during which time they've had no revenue at all, they've seen a real bounce back as soon as the stores open again because of the profile of their customer base. But all boils down again to having a viable strategy and executing it well. But people who are not on the front foot, who are overly reliant on bricks and mortar and not in the discount category, I think are going to have a very, very difficult 2021.
Seema, great to speak with you once again. I'd love to begin with your thoughts on how you're thinking about the end of this year in the context of everything that happened this year. Certainly everyone wants to know what happens next year, but is there any kind of simple way that you're trying to contextualize all that's gone on in 2020?
Yeah, it's been a tremendous year. But if you just look back at the beginning of the year when markets started to price in a full-blown global health catastrophe, and I think what happened is that investors who'd become really accustomed to years of low volatility and high returns were suddenly confronted with a really ferocious episode of volatility. And I think back in March, we would never imagine that we would see markets back at the kind of year levels, and if not at record highs. But I think what we've learned this year is that the power of central banks should never be underestimated. And once you have government stimulus also in play, there's a pretty hefty punch that policymakers can give.
And Seema, policymakers can limit downside, but how much, I guess we've seen in real time how much they can help upside. But I'm curious on a corporate level, how much all of this is going to end up contributing to earnings going forward. How do we need to, and what do we need to pay a special attention to when it comes to earnings and earnings growth going into 2021?
Yeah, it's an interesting one, because I think what we are anticipating, what the market is anticipating is an earnings recovery next year, which makes sense. I think that the question is around timing. So we still have a little bit of concern around the beginning of the year. And that's because, as you said, what's important is, are companies going to go back to normal? Are they going to be able to operate as they were? And will they still be facing capacity constraints? And the vaccine news has, of course, been positive, but there's still a lot of question marks. So to us, it means that the first quarter of next year, you still have a number of capacity constraints for most sectors. So earnings growth will still be under some pressure in Q1, certainly better than what we saw this year. And then we just want the growth recovery to really accelerate as we get into the second half of the year, to the point that earnings growth is then validating valuations, which we already know are very extended.
And there we have the opening bell on Wall Street at the New York Stock Exchange. Definitely a little bit less exciting today than the raucous openings for the past few days between Airbnb and DoorDash. Headwinds. Never heard of them? Definitely not as cool as Airbnb or DoorDash. Seema, I want to stay on the IPOs here. The market reception really has been absolutely tremendous. How concerned are you that how the market has responded to an Airbnb, a DoorDash, what is it, a C3.ai, whatever they're called? Is that a sign of a market top forming?
No, I don't think it is. I think what we're seeing is that, one, investors are looking through all of the concerns over, which may be pressing markets for the next couple of months, and looking through to the other side when hopefully there's economic normalization. And that's what they're looking. That's why they've got that almost exuberance about them. But also, these specific IPOs are for companies which are part of life going forward. We talk about life going back to normal, but some of it, that what we've experienced this year, will stay with us. And I think a number of the companies that we've seen with the IPOs this week, they are companies that have evolved this year and have almost, kind of normalized what will happen and will continue to be part of our lives going forward. And I think that's what we're seeing. So to me, it's not a concern of a bubble or a market top.
And I guess, Seema, in thinking about part of life and this normalization trade that I think markets are anticipating, embedded in that, are you concerned that if there is a slowing of how quickly vaccines roll out, or even if just there's a disappointment in, let's say, first quarter, second quarter earnings, will the markets penalize that because so much optimism has been pulled, optimism around next year has been pulled into returns in 2020?
Well, I think what we're likely to see, and I think we've seen some of that this week, is there's a bit of a reality check going on where markets are saying, okay, show me what the logistics are. We want to know what the reality is of these vaccines. So I think that over January, February, there's going to be good news along the way, but the market is going to be somewhat tempered in the way that they respond to some of that good news. So hopefully, none of this is going to come as a complete shock. And ultimately, we think that investors are going to look through all of that noise. At some point, the timing is difficult to say, but at some point within the next year, there will be global mass distribution of a vaccine, and hopefully life will go back to some kind of normality. And I think that's what we're looking for. But of course, look, there is potential for disappointment, and it's really important that from an asset allocation perspective, you maintain some kind of safety within your portfolios.
Seema, Miles wrote so eloquently in his morning brief newsletter today about this concept of operating leverage, and that has been very much front and center this year. Companies have fired a lot of people because their demand has really fallen through a trapdoor during the pandemic. How concerned are you that, given where valuations are right now, they're stretched 5-10-year highs, depending on what company, that we might see more waves of layoffs in the first half of next year as companies try to justify these valuations?
Yeah, I mean, look, that is a key risk. When we think about we've got a pretty optimistic view for 2021. And when people ask us, but what are the risks ahead? I mean, I think that is the key one, is that, things have been okay because so much policymaker help. But at some point, some companies are going to have to say, look, this has been too difficult. Let's throw the towel in. We're not seeing the progress as quick as we need it. So I think that is a risk for Q1. And I think we should anticipate that the road from here is definitely not smooth. It will be rocky and there will be some bad news along the way. But I just think that investors are likely to look through a lot of that because they know that the big picture at the end of 2021, or at least middle of 2021, is a pretty decent one.
We're looking at the market action today. All three majors down right now. It feels like the concerns around the virus spread right now, as well as the lack of optimism around the stimulus, some kind of stimulus deal, is kind of outweighing what we're expecting over the weekend, which is really the first rollout of this vaccine.
Yeah, I think that's a good point. I think the market is really looking for good news now in order to be able to continue to make progress in an upward direction. Right now, it feels like we're in a little bit of a sideways environment from an economic perspective. The vaccines certainly provide hope for next year. That's why we called our outlook for next year dark tunnel, bright light. We're still in that dark tunnel. We're still seeing the virus cases rise, the fatalities rise. It's going to be very hard for us to get convincing good news on the economy unless and until the caseload starts to go down, perhaps with the help of a vaccine. In the near term, we could get good news from a dovish Fed next week. The Fed could announce some kind of new measure that's incrementally dovish, like extending maturity on their open market operations, maybe even increasing the number of securities that it buys. Although I think that's probably one step too far. And also on the spending bill with the COVID relief attached. I think those are the next two perhaps sources of good news for the market to head higher.
Yeah, Brian, when we talk about the other side, the biggest risks that investors are identifying here, that was the topic of a Deutsche Bank poll out today. And not surprisingly, I don't think all the top answers had to do with the vaccine, whether or not that COVID mutates and dodges the vaccines that are currently out there, or if there are serious side effects to the vaccine, or if people just don't want to sign up to get these vaccines. Those seem to be the highest risks out there that investors are identifying. But considering that, I mean, how much upside might there be if those risks don't manifest themselves and you do see this rolling out in an operation as smoothly as Dr. Fauci and other doctors want to see?
I think there's considerable upside. I think when you look at what the market's expecting for just S&P 500 companies next year, about 22% earnings growth after about a negative 12 or 13% this year, we think that could be as high as 30%. Maybe we don't get to 30, but if we get to 25 or the high 20s, that means there's upside to the market as well. Now, we don't think the market will be up 30% next year. We think a lot of that 30% in earnings growth is going to help valuations come back down. That still means we have a pretty high conviction that the market will be more attractive at the end of next year than it is at this at this particular point in time, even if stocks move higher. So we're looking for mid to high single-digit gains in the equity market next year. There is some upside associated with that, but mainly that growth comes in earnings as a kind of a bounce back to what we saw this year.
Even with that said, Brian, you mentioned the uncertainty around the one-year outlook is continuing to fall, even as we see this optimism in the 3-4 months or so, so the medium term. What do you think is contributing to that decline, and why should we be watching that closely?
Yeah, it's pretty unusual to have a one-year outlook that is more certain and more positive than the 2 to 3 month outlook. But that's really where we are at this point. We just don't know how bad things will get from a health perspective in the next 2 to 3 months, what kind of impact that will have on the economy, on the ability of businesses to stay open, to retain workers. So the labor market is really the area that we're looking at right now as a focus for a kind of a bellwether for just how much are we going to give back from this recovery before we start to see the full normalization. But in terms of the one-year outlook, policy uncertainty has fallen a lot. The election result delivering that kind of mixed bag in terms of control of Congress probably reduces policy uncertainty a lot, at least reduces the range of possible policy outcomes. And also you have the virus, which I think counts as the vaccines, rather, which count as reduced policy uncertainty, because as we get to the middle of next year, if those vaccines are widely adopted and if they're as effective as they're billed to be, I think we're gonna get dramatically reduced economic uncertainty in a lot of industries that are really on their back still, able to get back up and get something close to normal revenues for the second half of next year.
And Brian, we've been talking a lot about stimulus hopes. It seems like a broken record when we highlight the updates coming out of Washington, D.C. there. It seems like much the same sticking points rearing their ugly heads again when we talk about defending legal liabilities there. And Republicans continue to push for it. It seems like we're at the same roadmap that we were before. So talk to me about expectations there and how that might maybe be the catalyst to trigger some of the moves higher. What are your expectations out of Washington, D.C. moving forward?
Yeah, we saw a rally last week, I think, on the new hopes for this bipartisan deal, $908 billion with sort of some provisions in there for everybody. But as it looks more and more likely that number is going to go lower in order to have to be able to pass the Senate, the question is what gets dropped? Is it going to be that state and local government advantage? That's something that's supported, for example, municipal bond market looking for more aid to the states to kind of shore up their budgets. Is it going to come in the form of reduced unemployment assistance? If we're sending out checks to everybody as opposed to targeting those who have lost their jobs, who've been out of work for a prolonged period of time, what does that do to demand? I would say that probably means more of that money is going to be saved or maybe used to pay down debt. Not a bad thing, but less of it is going to be spent than if you sent it to the folks who have the highest marginal propensity to consume, who are the people who are, again, living at the margins because they've had one or two people in their household lose jobs. So the preference for the market would be a larger package that has kind of a more inclusive provisions in it, but it looks like we're going to get something smaller, and I think that's what the market's adjusting to, that reality this week.
Brian, shifting our attention overseas, we saw a steep fall in sterling as the EU essentially warned that these prolonged talks with the UK could lead to no deal at all. So essentially, come January 1st, the UK won't have any deal in place with its biggest trading partner. How big of a market event is that likely to be, given the disruptions that we could see on the trade front?
Yeah, I think it's a big deal. And I think what we've learned in the past 4.5 years, which is about as long as it's been going on, is that there's, if there's a deadline that can be kicked back or pushed back, it's going to be. So I know there's some kind of, talks expected to go on over the weekend. The expectation is that they're going to have to continue talking after that. And what we're seeing is, obviously pressure on the British pound vis-a-vis the euro. We know the euro has already moved up considerably against a lot of other currencies, including the pound and the dollar. And in fact, the ECB has made some displeasure known about that this week, about the euro being too strong. And I think that probably even exacerbates the situation a bit more. If we do see a no-deal Brexit, I think that's bad, obviously, for the UK, but also for Europe, because it would represent, I think, a much higher move in their currency, which is not something they need right now, with a lot of the continent still in some form of lockdown and encountering a good deal of economic distress on account of the virus. So we're hopeful, and I think there's still kind of priced into the markets that there's going to be a last-minute deal and not a no-deal Brexit. But obviously, the longer this gets kicked back into later and later December, the greater the risks are going to be.
And finally, Brian, there's a lot of concern out there, or these new comparisons of are we back in 99 with Airbnb and DoorDash seeing that big pop in their debuts. Do you think there is too much froth in the market, or you think these numbers are justified just given the type of growth these companies have seen?
Yeah, I think this is exuberance, but not irrational. I think if you look at the companies that are getting the benefit of the doubt from markets, these are already much more mature companies with clear, successful business models compared to the ones that were being priced this way in 1999 and 2000 before the bubble ultimately burst. And I think it also is a sign that when things get back to normal, which is probably not going to be next year, but maybe 2022, investors are still going to be looking for those high growth companies, those business models that are innovating, that are disrupting. That's one reason that even before the pandemic, you saw these technology firms still as the leaders in terms of earnings growth and market performance. I don't think it's going to change magically just because we've had the pandemic and we've gone through it. I think starting in 2022, if we get back to a low growth world, unsatisfyingly low earnings growth, broad-based S&P 500 earnings growth in the single digits, you're going to be looking for companies that can earn 15, 25, 35% per year. And that's going to include some of these companies that are, again, newer to the market and are disrupting established industries in a pretty clear way.
Okay, Brian Nick, Nuveen Chief Investment Strategist. It's good to talk to you. Have a good weekend.
You too. Wells Fargo Senior Economist Tim Quinlan, who joins us in the stream right now. Thank you for being here, Tim.
My pleasure.
So let me ask you this. As you point out, most economies globally will register sharp rates of contraction in 2020. But then when you start looking at different regions across the globe, there's not only the expectation for growth, but I think in your most recent note, you pointed out here in the United States, by the third quarter of 2021, we are back to recovery. I mean, we will have finished our recovery. We won't be where we were in 2019, but there's slowdowns in the rearview mirror.
Yeah, I mean, I think the way you think of it is, we're going through this god-awful period this winter, but then on the other side of it, what you've already had is a pretty swift rebound in goods spending, and then that's augmented by a broader recovery on the services side of spending. And so, you get faster rates of growth in the second half of last year. And in fact, we do have the headline level of GDP growth getting back to its pre-pandemic levels by the third quarter of next year.
And when you look at other regions, because some investors will be making their decisions with this kind of data in mind, China's GDP, I believe you're predicting, will grow about 9.6% next year. What is it about China, other than they are the largest market essentially in the world, that makes that's an optimistic number, is it not?
It is, and it's a little bit of kind of a coiled spring effect. I mean, China used to put up double-digit percentage growth rates on a pretty regular basis from the late 90s through until the early 2010s or so, and then a kind of deliberate transition away from government-sponsored expansion of corporate debt there kind of resulted in them slowing to an engineered slowdown in the kind of mid-single-digit growth rates. And as they now kind of ramp back up coming out of this slowdown period, it's sort of lower base effects there that afford them that year of faster growth. I wouldn't drop my coffee if you actually had 10% GDP growth, but then it probably starts to taper back off into the mid to high single digit growth rates after that.
Now let's look what's happening in the Eurozone. I mean, when you hear the Prime Minister of Greece being optimistic about the multi-trillion euro bailout that's going to be coming, and bailout's not the right word, but the stimulus package, their growth is expected to be 3.4% in 2021. Does that signal that the Eurozone's out of the woods, do you think?
Well, if you were the Greek finance minister, you'd be enthusiastic too. I mean, you remember in the last cycle when, they had these long-term refinancing operations where it was, loans to the financial sector of these troubled Southern European economies with the expectation that it would all get paid back. And, there was no way that you'd get outright fiscal policy expansion and what would have been deemed as a bailout of these profligate Southern European economies back then. So the fact that you are seeing not just a low interest rate environment and expansionary policy on a monetary policy side, but an outright spend and fiscal policy support as well is certainly pretty supportive for growth there.
So when we wrap all of this up for an investor, You called COVID-19 a magnitude 9 quake. I'm now watching new shutdowns about to take place where I am in New York City. We're seeing that in California and major population centers of this country. It seems as if, the recovery that we're counting on for third quarter might get delayed because that would mean more people out of work, wouldn't it?
I think if I could leave you with a lasting impression here, it's the next 3 to 4 months are going to be worse than financial markets are braced for at the moment. But then beyond that, especially if you get to a point where you've got adequate distribution of this vaccine, across not just the advanced economies, but the emerging market economies as well, then you'll see something that we've never had before, which is, in an ordinary period, you have pent-up demand manifest itself through goods spending. In most advanced economies, goods spending is small relative to the much larger services side of the economy. You've had suppressed services spending in this cycle. We've never seen that before. And so that, as that kind of comes back online, we're looking for that to drive growth in a more impactful way. So whereas in the near term, I don't think people are pessimistic enough, in the second half of next year, I don't think they're optimistic enough yet at this point.
All right, so let's wrap this up with one last question. We don't expect the Federal Reserve to increase interest rates at all. I've had guests come on here starting to talk about inflation. As an economist, are you worried about inflation? Because when I used to cover the Fed, for 10 years, they've never gotten inflation, right? It hasn't existed. What do you think?
Well, I think that when you look at the expansion of not just the monetary base, but also M2. So it wasn't uncommon before to have a big expansion of the high-powered money. In this case, you've had a big expansion of regular cash money as well. And there's maybe scope for a bit of inflation, which is why the Fed has tried to steer expectations toward this new inflation level targeting. But as General Putnam said to the troops before the first battle at Lexington and Concord, don't fire till you see the whites of their eyes. I think, I'll wait until I see the whites of inflation's eyes north of 2% before I start really dialing it into our forecast.
So I want to bring in Mark Howard. He is BNP Paribas multi-asset strategist. And obviously these IPOs in particular, Mark, have gotten a lot of attention. Does it tell us that things are sort of bubbly right now and too frothy? Or is that there's just a heck of a lot of demand out there?
Great question, Julie. Thank you for having me on this December Monday. It tells you, and it's great we're talking about this week because the Fed is meeting on Wednesday. And this is all about what the Fed has done in terms of, pushing economic activity, supporting markets with their open market purchases and their incredible accommodation, and other central banks, of course. And that is pushing people deeper and deeper into other asset categories, including, what we call, private equity and venture capital. And those products are very expensive for the retail investor. So when you get an IPO like Airbnb or DoorDash, that's a form of venture finance that individuals can get their hands on. And so they get bid up very aggressively. So I don't think it says so much about broad valuations as it does about the reach for return at a time when yields are going to stay really low for a long time, and there just isn't that much growth equity available in the public market.
Mark, just playing off that, do you think the Fed has sown the seeds for the next bubble in risk assets?
I wouldn't interpret it that way. I think, as I said before, there is dramatic organic need for return. If you look at the forward expectations of public markets versus the historic returns, whether you're looking at public bond markets, public equity markets, the forward expectations are dramatically lower. And that is forcing people into other asset categories in the private market, such as venture capital, private equity, private credit, et cetera. And so I don't know that the Fed is sowing the seeds of bubbles. What's happening is the street and corporations are innovating. Julie mentioned SPACs. They're innovating and creating new outlets, new products. And that in turn is creating opportunity for people to try and achieve those returns that they need for their endowment, for their foundation, for their family office.
And when you think about, those dynamics going forward, Mark, are people maybe understanding those dynamics more quickly in this cycle than the last cycle, where there was a lot of hate towards the market rally off the bottom for several years? It seems like everyone kind of, got on board come September and now have been maybe a little more creative earlier in the cycle in how to achieve some of those targets.
Yeah, that's an interesting perspective. I don't know if people got on board earlier. I think what has happened is there's just a broader acceptance that around the world, central banks are on full duty and are going to stay on full duty for a prolonged period. And that provides underlying support to take a higher degree of risk than you might have in prior cycles. There just isn't the ambiguity about whether central banks will be supportive, both in the traditional fixed income markets, but also more broadly the capital markets. And so that comfort allows people to step in and buy the dip. So when there's a scare, like we saw a little bit in October, and we've seen previously in over the course of 2020, there's an awful lot of enthusiasm to buy these dips. And I think that's going to happen again in 2021 as we hit an air pocket inevitably, probably in Q1 sometime, and we have a pullback. You're going to see that same resurgence of enthusiasm.
Mark, what are you seeing in terms of institutional participation during both these moves and sort of the SPAC/IPO moves versus retail investors? And is that different at all from past cycles that we have seen?
Well, I don't personally interact with the Robinhood crowd and the individual investor group. My focus is on the institutional side, so I can't really opine on what's happening there. I read the public comments and the other information sources just like you do, and it's clear that there's an awful lot of individual activity that creates buzz and creates enthusiasm, especially around hot stories in the IPO market. Institutions are particularly the hedge fund community and some of the new SPV structures, whether they're SPACs, whether they're closed-end funds, whether they're BDCs. They're very involved in private markets. They're buying pre-deal equity. They're buying private loans, private credit, and they're very involved in the private markets as a way to get kind of outsized returns versus the public markets. And so when these transactions come to the public market, they're measured not against the S&P or the NASDAQ, but against what they can generate in private markets. And sometimes it works, sometimes it's compelling, sometimes it's not. But there's a real push into less liquid, higher return markets. And I think that's going to continue as long as there's optimism around the vaccine and optimism around growth in the second half of next year.
And just very quickly, Mark, is there also risk, though, in that?
Yes. Well, I think your prior segment was fascinating, talking about some of the nuances and concerns around distribution. Even more importantly, are concerns about the take-up of the vaccine. There are a number of people, as we know, not just in this country, but around the world, who are skeptical about taking vaccines and the exact time of a return to normalcy and the economic impact. We've had this K recovery, and the farther a normalization of economic activity is pushed out, the more acute that K becomes, and the bigger the disparity in economic outcomes for society, and all sorts of risks that come with that. So that's what we're going to be worried about as 2021 plays out. Not only do we have challenges in Washington getting effective policy pushed through, but we also have social stresses, just like we saw with the disputes in Washington over the weekend. If they pick up, that's going to be a crimp on economic activity and a concern for markets at some point next year.
Yeah, definitely something to keep an eye on. Mark Howard, BNP Paribas multi-asset strategist. Thank you so much. Appreciate it.
As the year wraps up and we continue to get retrospectives from various Wall Street banks, David Kostin and the team over at Goldman Sachs catching attention this morning and declaring, Julie Hyman, that 2020 is the year of the SPAC, and Goldman going through all the different SPACs that have come to market. I thought it was quite helpful. They had a graphic in there, all 36 of them. Nikola, of course, is the 34th best performing out of all 36, worth noting there. They kind of kicked the whole thing off. But I think also thinking about why SPACs happen at all. And as we see here in the lower third, Goldman's view is this isn't going anywhere. I mean, this is really the future of M&A and private capital deployment, at least as far as Goldman Sachs can tell.
they're sort of extrapolating, right, that things will continue at the current pace. So they are looking at a ratio, they say, of 5 times SPAC equity capital this year to target M&A enterprise value. So that's what these companies are looking at, and that's what they're paying here. So that's where they get their $300 billion number. And it really seems as though there are a couple reasons why, if you're a private company, a SPAC might be attractive to you. First of all, there's that guaranteed payout, right? You know what you're going to get up front. There's no sort of guesswork about negotiating the pricing of the IPO, not knowing where it's going to trade on that first day, but also not knowing where it's going to price necessarily. And there's also, as we know, not as much regulatory transparency that is required. Now, in the case of something like Nikola, didn't turn out so well in the end, because eventually things did come out that investors were not too happy about. But those seem to me to be the two kind of driving factors behind some of these SPACs.
With all due respect to Goldman Sachs guys, it's also the year of the McRib. But I also note this too: 53% of SPAC capital has come since Labor Day, according to Goldman Sachs. And you know what happens with that? Potentially more eyeballs. We've seen a lot of eyeballs, a lot of coverage on SPACs. We've brought a lot of these guests on to talk about the future of their companies, but more regulation. At what point does the SEC come out next year and start cracking down these companies? Because it is too easy to go public via a SPAC deal. You just don't get that type of scrutiny as you do the traditional IPO process. So I wouldn't be surprised the SEC comes out here and drops the hammer.
You know, and I think another interesting aspect here, and Vern Hobart, who used to be an equity analyst, he now writes a newsletter. It's called The Diff. It's on Substack, like everybody else's. He had a great note on SPACs last week, I think it was. And he made the point, which Goldman gets at here, which is that SPACs are this perfect example of how investors think today. Vern's point was that the average, like a good SPAC is better than average, and a bad SPAC is worse than average. And so really, it sort of distills down to, and look, Goldman is building their work like all shops do off what their clients tell them. And basically clients are saying, you know, Saz, we're willing to deal with no disclosures, but if this thing hits, it's going to hit better than, you know, a regular index fund, right? And if it flames out, whatever, fine, on to the next one. There's more SPACs where that came from. And I think that really kind of says it all about the market today. And we talked all show about the inability to get returns. Well, you got to swing for the fences. You got to bring that slugging percentage up. And I think that's an enduring theme from the last decade that I expect will continue as we get into the next. Let's continue our discussion about the state of the economy right now and what 2021 may have in store for investors. Joining us now for that conversation is Annetta Markowska. She is the chief financial economist over at Jefferies. So Annetta, let's begin with what we just heard from lawmakers on trying to get something done by the end of this year. You're expecting there to be passage of stimulus in the beginning of the next Congress at the end of January. And how do you see that timing gap, that 1 month, impacting the outlook, if at all, really, for I guess, the first half of next year, let's say?
So that was our assumption when we published our 2021 outlook about 2 to 3 weeks ago. But, you know, I'm optimistic that we might actually get it earlier. So in our base case, both fourth and the first quarter GDP are pretty weak, about 2%. And that's because, again, we assumed that the stimulus wouldn't be passed until January. That in that case, then money wouldn't really hit until February. And so a lot of the negative momentum that we're seeing in the data currently would actually spill over into the first quarter. Again, you know, given how things are going, I'm optimistic that we'll actually get that inflection point a little bit sooner, probably in January, in which case, you know, Q1 will look a little bit better. But Q4, you know, clearly things have slowed. We've essentially plateaued when it comes to consumption, employment. Manufacturing sector is kind of the only part of the economy that's still doing very well, as well as housing. But there's been a clear negative impact, and so we're desperately, you know, needing this fiscal support.
Annetta, it's Julie here. So if this particular package does not have the state and local aid, that seems to be one of the areas of dispute. What does that mean? You know, because we've been hearing that all along that the aid is urgent on all fronts. But one would think it's particularly acute for some of these state and local municipalities, right? Especially taxed as they are by the rising case count for coronavirus and public health systems, for example. So what are the implications of that?
Well, the transmission mechanism to the broader economy is through the labor market. And we have already seen some pretty significant losses from the state and local governments, first in the early months of the pandemic. Then there was a short period of stabilization, but in the last I would say 3 months, there's been, state and local governments have been sort of bleeding in terms of jobs. So that has been a drag on employment. And without this aid, I think there's a real risk that these job losses at the state and local level accelerate early next year. So, I think it's doubtful that state and local will make it into this bill, but hopefully, in January with the new president and the new Congress, they can tackle that again and provide at least something, for states that have had, significant revenue drawdowns as a result of COVID and that really need this money to prevent these layoffs.
Anita, you mentioned a February or potential February inflection point. What's the exit velocity for the U.S. economy at that inflection point?
So I think we'll be sort of starting at roughly 2% growth coming out of the fourth quarter. I actually, think consumption at some point will stall out completely. December, I'm really concerned about because of potential payback effects. We had a pretty strong Black Friday online, so I think November sales might be okay, but I'm really concerned about December. So we'll be sort of starting next year with very little momentum. And so, again, we do need this fiscal package to reverse that negative momentum, to get the economy growing. And if that's the case, which, again, I'm optimistic, then by the time we get the vaccine distributed to the masses, which is probably a Q2 event, we're going to be looking at a pretty sharp reversal. And I think the second quarter looks pretty good right now.
Yeah, I want to pick up on that, Annetta, because our conversation's been a little bit downbeat, but I read your note and I thought it was a great way to frame the investing conversation. Great rotation. Everyone talks, I guess, stocks, bounce into stocks or whatever you want it to be. And really, you're talking about the handoff from, I guess, what you could call like trend economic growth versus sort of this recessionary fiscal stimulus aided period. And I think you're quite positive on that transition as we get to the second half of next year.
I am. I think really once we get the vaccine, we'll really see that unleash the economic potential that's there. And you see it in the savings rate in particular. I think a lot of those savings are concentrated in higher income cohorts. And it's really a direct sort of flip side of the shortfall in service spending that we're seeing today as a result of COVID. So the money is there. I think the pent-up demand is clearly there. You look some of the travel surveys, et cetera, people are really dying to go back to living their lives. So the potential is there. We really just need the vaccine to be distributed to the masses to unlock that potential. And then you can very easily start a virtuous circle, right? With, again, initially high-income households spending on services, whether it's travel, eating out, et cetera. That will then create a lot of those jobs that were lost, these low-wage jobs that were lost as a result of COVID. And those are the households that are relying on fiscal support. So once you get that positive kind of virtual cycle going, the reliance of fiscal policy will also fade, and the economy will sort of be able to maintain that momentum on its own.
Anita, you wrote in one of your recent notes, you're not expecting the Fed to make any changes to its bond buying program this week, but just based on where you see the economy right now, it is slowing down. Would that be a mistake? Should the Fed be out there buying more bonds and buying them aggressively?
No, so we're in this very unique position where, we are clearly in a growth slowdown, but at the same time, we know almost with certainty that by 3 months, this growth slowdown will be over, right? Once we have the vaccine. And the problem for the Fed is that policy lags are quite long. They're at least 6 to 12 months. So even if the Fed responded today, whether it's, via twist or increasing the size of asset purchases, that action will not actually even kick in until the spring. And by then it'll be too late. By then you really won't need that support, as I mentioned earlier. So I think that's one of the reasons the Fed has been very reluctant to do the twist. And that's been a very consistent messaging from Fed officials in recent months, kind of leading up to this meeting. I think their strategy, and rightly so, is instead of trying to address this slowdown, which we can't really do anything about, let's focus on supporting the recovery in 2021. And the first thing that they need to do is actually provide guidance on QE to prevent a taper tantrum. That is one of the top questions I'm getting from clients these days, is how much are rates going to back up next year, and to what extent could that derail both the economic recovery and the risk rally? So I think the Fed's number one job going into 2021 is going to be to prevent a taper tantrum scenario, and forward guidance is a very critical component there.
Annetta, on a related front, when you talk about the risk rally, we've been watching the risk rally in particular when it comes to SPACs and IPOs and cryptocurrencies and anything that has sort of gone crazy this year. And we tend to talk to market participants about that, but from an economic perspective, are you concerned about a blow up then trickling through and coming back into the economy?
Well, again, one of the problems that, and the reasons that investors are really concerned about a potential backup in yields, because that's typically how you kind of uncover these situations, right? That kind of happen at the end of extended risk rallies. Is it's, you kind of get the tide going out, and then, it exposes all the weak links in the system. And I think that's one of the reasons, actually, the Fed needs to manage this exit and policy normalization very carefully. With respect to, some of the assets that you mentioned, for me, I'm concerned about broader financial conditions and about the credit flows to the real economy. And whether it's the Bitcoin or specs, I really don't see strong linkages there unless that morphs into a broader tightening in financial conditions, both in the equity, credit markets, mortgage markets, et cetera. And so that's what I'm, kind of paying more attention to and more concerned about.
And I wanted to ask you a question about that, because you point out to your clients that the combination of Janet Yellen and at the Treasury and Jerome Powell at the Fed will be a match made in market heaven next year. How does your client base and the rest of us benefit from that?
Well, we believe that market bubbles are created when a wave of liquidity hits a wave of newly printed money hits a fundamental rationale for an economic growth and for higher asset prices. And we believe that in 2020, we had the wave of liquidity. The Fed printed over $3 trillion, but we didn't have the economic growth because of the pandemic. That meant we had a great rally, but we didn't have a bubble. As we move into 2021, the combination of Jerome Powell at the Fed and the combination of Janet Yellen at the Treasury means that we think we get both elements of a bubble in 2021. We get another wave of money printing from the Fed to finance more stimulus. We get a real economic recovery, which helps that fundamental rationale, and we get explosive growth in corporate earnings. That creates that fundamental driver for higher asset prices that meets that wave of liquidity. And importantly, we don't think either Jerome Powell or Janet Yellen are in any mood to deflate a bubble if it emerges. And that means that if asset prices start really inflating, that a bubble could inflate bigger and last longer than any that we've seen in history.
So, Michael, then with all of that in mind, where are you adding exposure? How should investors then be positioned here at this point?
So I think first place is where you should not be positioned, and I would say that's in bonds. Right now, we're still very close to all-time lows, and I think the kind of conditions we're seeing in 2021, Jerome Powell may look through short-term blips in inflation. He may use his average inflation targeting rationale to ignore any inflationary pressures. Long-term bond investors may not. So we see rising interest rates as a definite possibility for 2021, but that will be more than offset in the equity markets by rising earnings. We particularly see some earnings power in the banking sector. We think that banks have over-reserved for COVID-19, and we think they could have some earnings releases, and rising interest rates and a steeper yield curve will be really good for them. We are also really excited. We think all this money printing is putting downward pressure on the dollar. That's really creating nice opportunities in international stocks. Europe and Japan have recently been big outperformers. We think that can continue in 2021.
So you also say, in addition to buy the banks, that high quality dividend stocks, X Energy, we know what happened with ExxonMobil and Royal Dutch Shell, but that income's going to be a scarce commodity in 2021. The banks right now, the regulators are crimping their ability to pay those dividends. Are you anticipating a release next year?
I think that we will see a lot of regulatory relief in the banking sector once it becomes clear that the COVID vaccines are starting to return economic growth. Once you've got a better underpinning in the economy, I think regulators are going to look at the massive reserve buildup that happened in banks in 2020, and they're going to recognize that some of that isn't going to be needed. And I think they're going to allow dividend increases and reserve releases as we move into the back of 2020. That will be particularly, I think, allowed from a regulatory perspective if bank earnings start taking off because the yield curve is steepening and they're getting a better net interest margin.
All right, Michael Jones,
Bank
one
of
thing
America.
we talked about at the beginning of the show was that Wells Fargo, Charlie Scharf, actually alluded to what you just said, but perhaps in next year.
Joining us now to talk all things capital markets as we wrap up 2020 is Elizabeth Crane. She is the Chief Operating Officer over at Moelis & Company. Elizabeth, great to talk with you this morning. I'd love to begin by just talking about how you are seeing the year 2020, what the meetings have been like through each quarter with your clients, and sort of how surprised you are that we are kind of sitting where we are today, given how things looked at the end of Q1.
Well, good morning. I'm so pleased to join you this morning. You're right. It's been an unbelievable year. And as you think about where we are, certainly from an M&A and capital market standpoint today relative to the last couple of quarters, it's been quite eventful. As we all know, first quarter was very active. And then from an M&A standpoint, business pretty much shut down in that second quarter and then began to resume over the summer with a focus on companies that benefited from the stay-at-home economy, more COVID resilient. And now we are seeing activity much more widespread across virtually every sector and led by both strategic and financial sponsors. And particularly at this moment in time, we're seeing tremendous activity in what we call that power middle, companies with a market cap between 500 million and 4 billion.
Elizabeth, it's Julie here. It's great to talk to you and get your perspective on all of this. Motivation-wise, where are a lot of these deals coming from? In other words, is it from an area of strength or an area of weakness in more cases, would you say?
I think it's a little bit of both. And there is certainly this desire on the part of so many companies to accelerate business transition. And that transition may have been planned. It may have been underway. It could be something they contemplated over the next couple of years. But this environment seems to be almost a catalyst for transformation. We've seen how quickly things can change. And companies are looking to M&A to position them faster, to respond to this environment and faster to be competitive in the future. So I actually think it's a little bit of both defensive and offensive is what we're seeing.
Elizabeth, do you think we'll see next year more radical transformations? And I'm already starting to see this to close out this year. S&P Global spent $44 billion to buy IHS. You have Tilray and Afria joining forces this morning. These are, at least to me, pretty big deals that fundamentally changes two companies. And it's not just them at this point.
Absolutely. And I think that plays into that theme of transformation. I think we're seeing it. I think we're seeing that acceleration of it across so many industries. And that was underway pre-COVID. That intersection of technology and any traditional industry is where we were spending considerable amount of time advising our clients. This environment is accelerating that. There's no doubt about it.
And do you think the fact that we are seeing rates where they are, I mean, presumably that's also a contributing factor. But do you think that there are deals happening that shouldn't happen? I don't know from your perspective if there are ever deals that shouldn't happen, because it's good for you guys the more deals that happen. But do you think there are, just as we are having discussions here pretty regularly about, are things overvalued in stocks right now? Are there too many crazy IPOs? What about in deals?
I think what we're seeing is actually greater confidence. And so, when you think about the components of what drives M&A, availability of capital, interest rates, but importantly, executive board confidence to undertake a transaction. And as we have come into the last quarter of the year, this fall, that confidence level has definitely increased. Companies, including financial sponsors, as they're looking at acquisitions, there's greater confidence in the outlook for 21, 22, that ability to predict or see line of sight, underwrite a business model, and transact based on that confidence in line of sight into how an asset might perform. So we think that work it's underway, and it's not. It is. I would attribute it much more to confidence in the outlook for these businesses at this point in time.
Speaking of that outlook, Elizabeth, I want to circle back to something you mentioned at the beginning, which is that power middle, that $1 to $5 billion type acquisition. I mean, this sounds to me like a conversation we would have had 2017, 2018, private equity, capital on the sidelines. Look at all these deals they want to do. I mean, in some ways, are we continuing simply that theme after kind of a pause for, I guess, the rate hikes in 18, and then pause for the pandemic?
I do think that is a continued theme. And when you look at the amount of capital that private equity has to deploy, globally, it's about $2.5 trillion. It's significant capital. And so that theme is underway. But the added aspect to that is that coming back to this confidence, private equity potentially was certainly less confident in Q2 and over the summer as they look towards the future at broader industry opportunities. They are confident in what they're seeing in terms of business models as we head into 21, 22. I think the other thing that we're seeing is this idea that there is, that we will see, I should say, this idea that there's this pent-up demand. I mean, as an individual society, there are so many activities, experiences, products that we're not undertaking right now. And that will be, I believe, another accelerant of M&A activity. And I'd look to private equity to have their eyes on those opportunities and be in front of those opportunities with a confidence level that they can, that we're seeing the other side of this environment, if you will.
Elizabeth, do you think SPACs, what we've been seeing, is that activity good for the market? Certainly the argument could be made, these companies that are coming public via SPAC, they're receiving less scrutiny as opposed to if they would undergo the traditional IPO process.
Well, I think we believe SPACs are a alternative vehicle for a company to go public. So if a company is ready, if they're prepared, a SPAC, listing through a SPAC can really shorten that time frame to launch, to be public. And it is, we believe, a permanent sort of alternative. That doesn't mean, IPOs are very much, and we're seeing it in this market, an important means for a company to list, but SPACs are a very attractive alternative. And I think what's also interesting about SPACs is for a management team that's considering a listing of IPO through a SPAC, the initial partnership, if you will, access to the experience level of the SPAC executive team or even of the sponsors can really be an interesting and added and valuable complement in those early days of being public through a SPAC. And I don't think you get that through a traditional IPO.
Yeah, and that's perhaps an angle that we don't talk often enough about. Elizabeth, finally, I wanted to ask you about a change that you all have made at your firm. Ken Moelis, the CEO, recently told Bloomberg, people who work for Moelis can live wherever they want. And so I'm curious, I don't know how recent that sort of allowance is, but I'm curious what the take-up has been on that. I mean, you guys, have over 800 employees, I believe. Are people moving all over the place?
So, in this environment, we, our most important asset is our talent, our people. And we have wanted to provide as much flexibility for our bankers to work anywhere and any way that they want to in this environment. And at the same time, what we're seeing is we are seeing our clients are moving to certain locations. We already have 6 offices in the U.S. I would expect in the next couple of years, we may have a few more. And there's going to be a business imperative to have those offices near where our clients are located. That will provide greater flexibility to our employees. I don't doubt, though, that we believe employees will continue to come to the office. There is a learning, a process of development, culture, that virtuous cycle that happens when people are physically in the room. And even though so much is being done in a virtual environment, it's still different when you're face to face. And there's real value in that. So we're going to take the best of what we learned in this environment. I am confident we will have a flexibility in how and where we work in the future. But we also believe that individuals are going to keep coming into offices and conduct business in offices in the future. It just may look a little different.
Certainly with the weather we have moving in today here in New York, it's nice to not have to leave the house. But I think we all wish, certainly the three of us here at Yahoo, wish we could be all in one place. All right, Elizabeth Crane is the Chief Operating Officer at Moelis & Company. Elizabeth, great to speak with you this morning. Have a great holiday, great New Year, and hopefully we can talk face-to-face sometime in 2021.
I look forward to that. Thank you for having me this morning.
Joining us now for that conversation is Tim Chubb. He is the CIO over at Gerard. Tim, great to talk with you this morning. I'd love to begin with risks that you see in the market as it relates to sentiment. I mean, Bitcoin is certainly a part of broader financial market sentiment. And we were talking to Randy Frederick of Schwab earlier. He's talking about, the put-call ratio is all out of whack. How concerned are you about the setup as we head into the beginning of next year?
Yeah, thanks, Miles. I'm fairly concerned. I mean, we definitely have seen a lot of speculative, euphoric type behavior within the last, several weeks, and really coming out of the election and some of the positive vaccine news. Value trade has been very hot for the last 6 weeks or so. But it's just one of those things where you look at the put-call ratio, look at the number of stocks that are trading over their 200-day moving average. At some point, you're going to have a shift where everyone needs to run to the other side of the boat, and obviously that's going to cause quite a bit of market volatility. I just think there's a lot of headwinds for stocks in the short term, and while the backdrop and fundamentals for the long term and the second half of next year are extremely positive with the economy normalizing, I think everything from money supply being a risk for inflation potentially next year to just the broad valuation overall for the market. And as of course, we are seeing a lot of sort of speculative behavior in certain stocks that are certainly a cause for concern as well.
Hey, Tim, it's Julie here. And so if that's your view, is there any place that you're going for sort of protection in this market, or something that you think is going to be more resistant if we do start to see a pullback?
Yeah, so I think for us, we're rebalancing right now. We're maintaining our asset allocation for our clients and taking some money off the table. If we do get a pullback, we don't think it's going to be something where it's a bear market or even a decline like we saw in March. Will likely be a routine pullback. But unfortunately, I think a lot of the more safety bond proxy sectors like real estate, utilities, staples, unfortunately next year are likely to be not great areas to invest in, and likely to be an area where we may underweight, just because of how sensitive they are to rates moving higher. They don't have as much pricing power, lower growth, et cetera. So for our clients, I think, rebalance into fixed income, especially on the credit side of things. I think if we do get a pullback in equities, credit should hold up a little bit better than, equities overall. But we really like healthcare going into next year. We could head a little bit of a speed bump depending upon how the outcome in Georgia in early January turns out. But you have a sector that's, really faced with a lot of nice secular growth tailwinds. Related to an aging population, pricing power, a lot of M&A activity that's trading at 17 times forward earnings for 2021 compared to the S&P at 23 times forward earnings. So I think that's a nice place to hide out, especially given the secular growth backdrop and how that sector, I think, checks a lot of boxes from growth to value, quality, and everything in between.
Tim, we haven't had this discussion for a while on the show. It was discussion a lot of times in the summer, the V-shaped recovery. We have the vaccine now getting out there. You have a stimulus deal potentially this week. Do you think that those two things, you combine them together, especially with the Fed liquidity continuing to run rampant, we might have that V-shaped recovery in the first half of next year?
I'm not so sure about it taking place in the first half of next year. I think if you look at the Fed real GDP now forecasting for the fourth quarter continues to move a bit lower. I think we have a lot of dark days ahead of us due to COVID-19 cases here within the next month or two. So it's going to be very difficult, and I think maybe a little bit of a larger or wider range of outcomes for the first half of 2021. But to your point, I think we are going to have a pretty significant recovery end of the second quarter of next year, especially depending upon the level of vaccination that our country is able to achieve. And the second half of next year in 2021, I think will be extremely rewarding for investors and Americans who are just looking to get their lives back. And so as a result, I'm pretty optimistic about the consumer discretionary sector, especially in durables and cosmetics and really anything that is exposed to the American financial position, which I think despite what we've gone through this year, not to be insensitive to those Americans who are really struggling right now as we face further lockdowns, but I think it's a sector that really rebounds quickly given just how low debt levels are on the American balance sheet, and being that there's a lot of pent-up demand, and I think all of us are looking forward to taking vacations and getting back out there again. I think the reopening trade and to your point, the V-shaped recovery for the second half of 2021 ultimately will be positive for some of the reopening value-oriented names that we've seen move in the last 6 weeks.
And Tim, let's just finish up with thinking about some of what's happened in the last few weeks. Again, we kind of began the segment talking about Bitcoin, but we've seen what's happened in the IPO market. SPACs are going nuts. Sentiment right now is at an enthusiasm level that I don't know what you would compare this to, but we've heard comparisons to a lot of other periods that were quite frothy in market history. How are you thinking about that? Is it concerning to you? Does it feel like it might lead to a broader mania, or are you okay saying, look, if everyone wants to get excited about electric vehicle SPACs, have at it? I think consumer discretionary is still going to be okay in that environment.
Yeah, I think there is a extreme level of optimism right now, especially in the face of some of the negative news related to shutting down the economy in certain areas, as well as the COVID-19 cases rising. But I think it underscores the exciting environment that we're heading into in this new economic cycle. I guess to answer your question, in the short term, I do think we're going to have a moment where everyone runs to the other side of the boat, and it could cause a bit of a pullback and some volatility within the markets. But I think if you zoom out, I think investors are really looking long term. And while the valuation of some of these companies really doesn't make sense to us, and I know I call them traders as opposed to investors, just buying a narrative as opposed to a business and the underlying fundamentals of that company. But I think especially with the Biden administration coming in and the news yesterday with the energy secretary and the opportunity that exists for alternatives, we have some large secular growth tailwinds that are really exciting. And for the last 12 or so years now, population and productivity growth have been extremely low. We're now entering a phase where population growth may be picking up due to millennials entering their peak household formation years, and productivity growth certainly picking up as we've seen so much disruption take place and accelerate during 2020. So, the optimism's warranted. I don't know to the level that we've seen, perhaps. Again, it's been more people trading off narrative as opposed to the valuation of these companies, but there's really a bright future ahead of us, I think, in this next decade. And once we can get through, the COVID-19 crisis, I'm really looking forward to seeing what our U.S. economy can achieve in the coming years.
Ed Yardeni, President and Chief Investment Strategist at Yardeni Research, because some people may be making a mistake as they go into this market. And the last guest, Ed, talked about what's about to happen with Tesla next week, going into the S&P 500. You refer to it as a melt-up in the price of Tesla. Tell us more as investors why we need to be very careful right now.
Well, I often get asked these days what would I do right here if I had a lot of cash and I hadn't been in the market. And I'm kind of, I don't have an answer. I've been bullish since the beginning of the bull market, and I would just stay with the positions that one might have added in recent years. But right now, there's just way too much bullishness. Everybody's bullish. And we have signs of speculative excess with Tesla and with some of these IPOs. So I think you want to be a little bit careful. We already had our Santa Claus rally. It just happened in November. Maybe we'll get two this year. Maybe we'll get another one before the end of this year in December. But I think at this point, just don't speculate too much. Just stick with quality names. Broaden out. I agree with your previous guest who said that the market is broadening out from the
I call them the Magnificent Five. Add Tesla, this Magnificent Six. The outlook is actually pretty good for next year once we get through this pandemic. Once a lot of us get inoculated, we should see the economy doing very well in the second half of next year, going into 2022. That's what the market's been discounting. Market does look forward, and it's actually done a very good job of anticipating a V-shaped recovery in the economy so far. But the economy is slowing because of the third wave of the pandemic, and you have to factor all that in when you're managing a portfolio these days.
So, Ed, with all of that in mind, I know you're saying to broaden out right now, it's not just going to be those 5 or 6 stocks here that have been leading the way over the last 8 or 9 months. More specifically, though, what do you like in this type of environment? Because there's still so much uncertainty out there.
Well, they say the market doesn't like uncertainty, but as you know, we've had a lot of uncertainty since the pandemic hit. We didn't know whether we'd have vaccines. We didn't know how long the pandemic would last. We didn't know how the economy would respond. And yet here we are with the stock market in record high territory. And I think it does have to do quite a bit with what the Fed has done. The Fed has provided a tremendous amount of liquidity. The Fed is doing its best to make bonds very uninteresting. And I've been looking at the Fed's purchases, and the Fed's been doing a lot of purchases in the long end of the marketplace, notes and bonds, buying them faster than the Treasury has been issuing them. So they've been keeping the bond yield, the 10-year bond yield, below 1%. And as you know, a lot of other yields are at record lows. So there are probably some yield opportunities still in the corporate bond market. But at this point, I think the issue really is stocks versus bonds. And it certainly looks to me as though stocks should be overweighted. Maybe what's really changed in the stock market, at least since November, since we've had talk about vaccines, and we're actually seeing distribution of vaccines, the market's broadening out to anticipate a broader economic recovery in the second half of next year. And so that, yeah, go ahead.
A lot of what we keep hearing, and you actually allude to this, is the old phrase, irrational exuberance. And then here's an example. All of us can name people who've lost money with cryptocurrencies, and yet we look at Bitcoin over $20,000 a coin. What is that telling you?
Well, I tell everybody, don't come to me for advice on Bitcoin. I'm an old-fashioned kind of guy. I like dividends. I like earnings. I like coupons. I like rent. I like streams of income that I can put some value on. Bitcoin, you really almost have to look at the charts. It's the crowd. It's whatever the crowd thinks Bitcoin should be worth. That's what it's going to be worth. I look at the chart and I see it retesting its previous highs, making maybe new highs here. And that's the kind of chart that most technicians say you may actually want to short or at least lighten up on your positions. But I'm certainly not astute enough in understanding what drives the crowd in thinking about Bitcoin. So at this point, I would actually rather go for silver and gold investments than Bitcoin, because I've got more familiarity with what the supply and demand is there than what's going on with Bitcoin. So Bitcoin, you're kind of on your own. Though at these levels, I'd rather buy stocks that have underperformed.
Joining us now is Winnie Cesar. She is head of credit strategy at Wells Fargo. Winnie, good to see you. I'm curious, given what you saw the Fed announce already, what are you expecting to hear, or what would you like to hear from Fed Chair Jay Powell at today's press conference?
Thanks for having me today. So we're expecting to hear a continued cautious, dovish message. We're particularly focused on the kind of re-racked outlook for the economy. It does seem that the Fed has gotten a little bit more constructive in the near-term growth and employment outlook than their last summary of economic projections. And within that vein, there's a lot of moving pieces. We need to have the Fed maintain its dovish policy while also acknowledging that perhaps the economy is going to continue to maintain momentum, particularly if we do see some fiscal stimulus come down the pike over the next couple of days. And so that really puts asset prices, particularly in corporate credit, in kind of this 10-year tenuous situation and requires investors to be much more nimble than they have been for a lot of this year, where the beta compression trade was a really solid trade for a pretty extended period since March.
Winnie, what would you ask Jay Powell if you were at the press conference?
I would ask him what kind of the upside scenario actually is. You know, if we start to see growth accelerate, perhaps at a greater than expected pace, you know, sooner than the second half of 2021. If we look at the labor markets and their projections for over the next 12 months, it kind of gets us to a similar level to where we were in 2015 or 2016, when the Fed had actually started to telegraph a message of tighter policy. So I do think that there are some kind of pieces that need to be reconciled in terms of the economic outlook, how it compares to historic precedent with what the Fed has done from a policy perspective. And really, if there are long-term concerns about real structural changes to the economy that require the Fed to stay in zero interest rate policy and quantitative easing basically in perpetuity, that's something that credit investors really need to know.
When you look at bond market opportunities in 2021, the early part of 2021, what will look attractive? Will high yield and leverage loans look a little more attractive then than they do perhaps right now?
So we are constructive on high yield and leverage loans. We've been pretty constructive on high yield for a good chunk of this year post the real spike in volatility in March. And we're starting to get much more constructive on loans as well, mostly because the dollar price upside there is pretty considerable relative to the fixed income universe. If we expect that the economy is going to continue to recover over the next 12 months, default rates should continue to fall to lower levels, closer to kind of long-term median levels, and the capital markets stay open, then leveraged finance is probably a pretty good trade, especially if that front end of the yield curve remains really pinned down. I think that any sort of steepening in the treasury curve, even modest steepening, can do some pretty significant damage to investment grade portfolios where duration is much longer. It's gotten much more extended over the course of this year with issuance. And that means the potential for total return losses up in quality out the curve are pretty material as we re-rack to whatever new yield curve regime we end up in, even if it's a modest steepener. So we're very constructive on the leveraged finance universe, even though it does feel like high yield yields at 4.4% are kind of a tenuous start to the year.
Lindsay Piegza now, she is chief economist at Stifel. So Lindsay, let's paint this picture for a moment. We've got rising COVID cases. We've got unemployment claims continuing to rise. We have retail sales, we found out today, weak for the second consecutive month. Should the Fed have moved more aggressively now? Because when you think about their next meeting at the end of January, most of the damage to this economy may have already been done.
No, I think the Fed actually was very anticipatory of lingering weakness because of the virus. And they took very aggressive, unprecedented actions early on to help stem that weakness right away. And maintaining these programs will continue to provide support to the economy. So I don't necessarily think they needed to initiate new programs, but it is very important that they keep these programs in place to continue to provide support to the U.S. economy as we continue to see more cases, more restrictions, more job layoffs, further weakness in the consumer. And now one other thing is that the Fed, while keeping these policies in place, has been very vocal of handing over the baton to the federal government now to step up. I do expect that we'll hear further comments from the chairman in the press conference underway here in just a few minutes, really emphasizing the need for further fiscal support, essentially saying the Federal Reserve has done everything they can to support the economy to ensure a smooth functioning of the markets. Now it's up to our officials in Washington to continue to provide that artificial support needed at the individual and business level.
Lindsay, hey, it's great to see you. Jay Powell hasn't really veered. Back in November, he said that the program is delivering about the right amount of accommodation and support for markets, and so it continues. But the reporters are going to try and pin him down on this issue of what they purchase, the assets that they purchase, and the duration of those assets. And Brian was just saying there's no need right now to actually be purchasing, say, the 10-year or the 30-year. Do you see that? Is there a trigger we should look for as investors that would signal that the Fed's about to do that?
Oh, I don't think it's that easy. I don't think there's one specific trigger, but I do think that the Fed is going to continue to keep its options open. And Powell is likely to be very vague in his response to any type of questions around that, suggesting that the Fed very much could keep purchases at the current level, but simply extend the duration or ramp up purchases altogether. So by reiterating the fact that the Fed is willing to do either of those, what they're trying to do is really reinstate confidence in the market without even having to change the current securities program. So again, the Fed is going to keep the door wide open on further support, but being very vague, very uncommittal in terms of what they will actually do, what eventual changes we can expect as we turn the corner into the new year, where we will expectedly see further weakness in the domestic economy.
Lindsay, you brought up stimulus a moment ago. What does easing by the Fed alongside stimulus do to the U.S. dollar, to the inflation picture in 2021?
Well, in 2021, I don't think it does much. Right now, inflation is not a near-term concern. Now, certainly when we talk about the federal government pumping in trillions of dollars, there's generally an inflationary concern down the line. But at this point, I do think that a very tepid recovery marred by persistently elevated level of joblessness as well as a weak consumer is going to trump that increase in money supply. So essentially a weakness in the velocity of money component offsetting that increase in the money supply. Now, long term, I do think there are inflationary implications, particularly if we continue to see a ramp up in debt and deficits not offset by any type of tax increases or spending cuts on the federal government side. But right now, near term, the Fed is not concerned about any inflationary concerns as they really have struggled to get inflation back to their 2% target for the better part of the past decade. And in fact, now with a more flexible approach to inflation, with headline PCE running about 1.3% since 2015, the Fed could essentially allow inflation to reach 3% for the next 5 years and still not exceed that longer term average of 2%. So there's plenty of leeway, plenty of wiggle room for the Fed to allow prices to increase, which will give them even more leeway or runway to keep rates at extremely low levels for quite some time.
Inching closer to the finish line, lawmakers looking to hammer out a $900 billion stimulus as they work up against that Friday deadline to fund the government. Some disappointing economic data out this morning weighing on investors potentially here. Retail sales falling 1.1% in November, the first drop in 7 months. And of course, the central bank in focus today with the Fed decision out later today. And that is where we begin this hour. We've got Randy Kroschner. He is the University of Chicago Booth School of Business Deputy Dean and Professor of Economics. He's, of course, the former governor of the Federal Reserve. We've also got Brian Chung joining in on the conversation. And Randy, it's always good to talk to you. It feels like right now that we're seeing sort of these two contrasting narratives play out. On the one hand, there's optimism about where the economy could be 6 months from now because the vaccines have started to roll out. And yet we're also looking at the tightest business restrictions we've seen since the beginning of this pandemic. How do you think the Fed's going to be weighing these two today?
Yeah, it's a real challenge for the Fed because, of course, you got the short term, which is not looking so good, not so great data out on consumption, unemployment claims up, and obviously more lockdowns or either just people being scared to go out. So it's going to be a tough next month or two. But in the intermediate to longer run, we've got the vaccine coming, which is just amazing that in 10 months, we've gotten 10 years worth of innovation that we're going to get that vaccine. And so probably by the middle of next year, we're going to start to see things pick up. So the Fed's, it's pulled in two different directions. And so I think we're going to get a little bit more support right now, but not too much because they want to keep their powder dry just in case something does go wrong going forward.
It's also kind of tricky. I mean, it's a position I wouldn't want to be in for Fed Chair Powell. We've heard him kind of stress this in his congressional hearings, is that there's a lot in flux here. And generally, the Fed is good at kind of giving guidance when they're working within the parameters. But we're still watching to see what plays out on the stimulus front, still watching to see how the vaccine rollout's going to go. I mean, there's so much up in the air. How difficult is that if you are Jerome Powell stepping in the mic to kind of try and give the markets a little bit more in forward guidance, but also just have completely unprecedented obscurity in terms of where things go from here?
Well, I think he'll continue the message that, like, basically we stand ready in case something goes wrong to provide the liquidity, provide the support to make sure that we don't have a financial crisis, to make sure that the markets continue to function. But he'll probably underscore that we can't do it alone. I mean, if the virus is either scaring people from going to the office or consuming, or lockdowns and restrictions are preventing them from doing so, no matter how much the Fed does, no matter how many assets it buys, no matter how low interest rates are, that's not going to help. So he's going to say health and fiscal policy need to come in.
Hey, Randy, it's Brian Chung here. Great to speak with you. So I'm going to ask for a little bit of help here. I'm going to be in that press conference later on today. What is the biggest question right now? Because as we've already laid out, there might not be any new action. It might just be them keeping their powder dry on quantitative easing. But there's so many other issues, like the extension of the Federal Reserve's liquidity facilities, if there's a new Treasury Secretary, that fiscal package that's moving through in DC right now. What do you think is the biggest pressing question that you would like to ask the Fed chairman this afternoon?
Wow, there are so many questions I'd love to ask Jay, but I guess probably the most important one would be kind of along the lines of what we were discussing on, given that there are a lot of challenges in the short run, but the long run looks a little bit better, that there is some light at the end of the tunnel. How are you going to manage the short run to the long run? How are you going to manage, in particular, the exit of all the support that you're providing? How do you do that in a way that is not going to upset the markets? We know that Ben Bernanke tried to do that with the so-called taper tantrum, and it didn't work out so well. Eventually, he got the markets calmed down, but how is he going to think about that? How is he going to get the markets prepared? What is he going to be looking at in order to make his decision, as well as get the markets making the right decisions in advance of his decision?
And Randy, when you talk about the light at the end of the tunnel, what's your assessment on how long it will take for the impact of the vaccine to show through in some of the economic data?
I think it's going to be a few quarters. Certainly, I think this is going to be a tough quarter with the increases in cases and additional restrictions. We will slowly start rolling the vaccine out. I'm here in London at our London campus, and of course they started the vaccine here a little bit earlier. But still, it's going to take quite some time before a significant fraction of the population is vaccinated. I think, fortunately, we'll start with the most vulnerable, and so that is going to be, I think, very helpful in reducing the number of fatalities. But then to get people confident to go out, you've got to have more and more people vaccinated, because this is sort of an invisible thing. It's not something where you can just see, that person has the virus and can infect me. People can look perfectly normal and can pose a risk to you.
Now, of course, at the same time, though, the Federal Reserve economists are not epidemiologists, but they are being forced to kind of factor that into the economic projections that they'll be offering. We'll have a re-up of that in the statement today at 2 p.m. with the summary of economic projections. At the same time, the Fed is also going to be releasing new charts that map out the uncertainty and the risk that surround key factors like real GDP, inflation, also unemployment. Is there a risk here that actually might cloud or make it even more complicated to read through the Fed speak here? Or do you think that these types of disclosures are actually a good thing for the Federal Reserve to have in its toolkit over the next period of time?
Well, I think eventually it will be, but I think at first there's always an opportunity for misinterpretation and misunderstanding. It can be very difficult when you introduce something new to say, don't be scared by it, because my guess is most of the Federal Reserve members are going to say, hey, this is a pretty risky time and the downside risks outweigh the upside risks. But that doesn't mean that they think the economy is going to go off the cliff. It's just that they want to be prepared for that, and they want to warn people that they are thinking about that and they're ready for those eventualities. The challenge is people could say, "Oh my goodness, they said we're going to go off the cliff," and then people start to run for the hills, and that's not what they want. That's going to be Jay's very difficult job in the press conference, to be able to express what they really mean by this new information.
Randy, I mean, we've heard such consensus from a lot of the investors we have come on the show to talk about how rosy 2021's looking. A lot of people just in that bullish camp, and that always raises good questions about playing the other side here. I mean, when we're looking at what's being played out in this potential $900 billion stimulus that Republicans and Democrats are agreeing on, a piece of that's going to be stimulus checks getting sent out. We'll see where the final number comes in here. But are there risks now that you're seeing maybe come out and potentially, I mean, we already talked about the personal savings rate being a lot higher than people expected. Once we return to normal, that there could be maybe a possibility of seeing inflation run ahead of schedule here and what that might do. Outside of that, are there any other risks that you're seeing potentially that might be overlooked right now?
Sure, and in some sense, the Fed is hoping to get a little bit above 2. I mean, they have that new average inflation targeting framework that said, well, gosh, we've been missing our target for the last 8 years because we put out a 2% target in 2012. We haven't gotten to 2% once. And so we kind of want to get 2% on average. And so that means we'll run a little bit hot. That is, allow the inflation rate to go a little bit above 2 for some time. So we may get into a situation of 2 to 2.5% inflation. And I think the Fed's going to be comfortable with that. And the key is that will the markets become comfortable? Will they say, oh, my goodness, the Fed's forgotten its 2% mandate, and is 2 to 2.5 mean that next time it's 2.5 to 3 and 3 and more? That's not something that I think is a major concern, but I do think that there, again, could be an opportunity for misinterpretation because this is something new. This is a new framework.
Randy Kroschner, Dean and Professor of Economics at the University of Chicago Booth School of Business. It's good to talk to you as always, and our thanks to Brian Chung as well for taking part in the conversation.
Joining us now to talk all things economy and what the future of markets has in store for investors is David Zervos. He's the Chief Markets Strategist over at Jefferies. We're also joined by Yahoo Finance's Julia LaRoche. And David, we have a lot of really interesting things to get to. I'd love to just begin by talking about yesterday's statement from the FOMC, what we heard from Jay Powell, and how that changes anything that you were thinking about where the Fed fits in as we get into 2021.
Miles, doesn't change much for me. I think the meeting was probably the most boring meeting of the year, which is what I told our clients. I didn't expect the meeting to give us anything new. I know there were some people talking about twists and adding a few extra 10 years into the purchase program and the like. Not something I was looking for. It's very hard to see the Fed even tinkering a little bit with things when financial conditions are in a really, really good place. Equities are at record highs. It looks like many of the sectors that are interest rate sensitive are doing great. Those that aren't, we expect to do better once the vaccine kicks in probably by Q2. So I think, the Fed just did a little victory lap. It was quick. It was easy, painless. The market might have had a little bit of disappointment for 30 seconds that they didn't buy a few extra 10-year notes, and then the 10-year note yield went right back down again. So I really don't think there was much new. People are going to talk a little about, the guidance being stronger, but we knew the guidance was strong anyway. They told us in the last few SEP projection forecasts they weren't really preparing for liftoff until at least 2023 and probably beyond. So I don't think there was any new news at all in the Fed's statement or the press conference.
Gotcha. So David, obviously your takeaway for clients is that it was a boring Fed meeting, but as we head into 2021, I am curious about how you're thinking about the markets in terms of like how you would structure the trade. I know one that we had talked about for a while was SPOOs and blues. And I know back in March, we had a conversation around, risk parity kind of entering the danger zone and then kind of shifting that trade. What is the trade structure for you today?
Well, Julia, today we shifted in April and May away from short-end treasuries as our hedge because they rallied 150 basis points. So we were levering that part of the yield curve in a vol-adjusted way to hedge our equities, which is a classic risk parity trade. Once that yield structure in the treasury market moved, we actually moved into IG, which worked out really well. IG yields in the front end were north of 2%, even 2.5%. And those have come down to sub 1% now. So not only did our S&Ps work, but our hedge worked from March and April. So we've had a really good year in what I called SPOOs and SIGs being short-term investment grade credit. That said, there's nothing left in investment grade credit now. So we're kind of stuck. I think there's two choices for risk parity investors. One is a hedge in the currency markets for an event where we go risk off, which would be a tightening in financial conditions that's probably a mistake or unwanted, maybe a Fed mistake or a administration mistake or a Congress mistake. That would send the dollar rallying, particularly against more the commodity type currencies, Aussie, Mex, and the like. So maybe you could have a long dollar hedge to a long S&P position, or you just say, you know what, I got two great things next year. They both start with J, Jay Powell and Janet Yellen. And I just go with something like SPOOs and Jays, and I don't really even have a hedge anymore because I know these guys have figured out their backstopping techniques. Janet honed it during 2014 to 2018. And, Jay's really come a long way from the 2018 fiascos, 2018 fiascos that really at the end of the year caused some problems for us. So I think, Jay's in a good place for at least a year. He probably won't be the chair, in my opinion, next time around with a new administration. But again, I think with Janet and Jay, you've almost got a hedge you don't need to pay anything for.
You forgot your J for Jello, David, which you wrote about.
Yeah, we could do that too.
You resurfaced a note that you had written about Janet Yellen years ago, which basically said it's time to party with her back in the driver's seat. But I am curious when you're looking ahead to what she's able to do, right? Because you see a Congress right now that is really struggling to get stimulus done. So I'm curious what you expect from her in terms of, getting the ball over the finish line or whatever bad sports analogy you want to use. What's she going to be able to do in that position?
Look, I think Janet is eminently qualified to get in front of Congress, talk about the need for certain types of stimulus. I think the way the Democratic Party has couched stimulus is a little different than in the past. It's less about transfer payments and more about things like education, like healthcare, making sure we have a safe and smart environment in the United States, and how those feed back into positive growth. It's even less on infrastructure, which I'm quite positive to see that switch. I do think making sure those that don't have access to education and healthcare get it. It's a huge boom, long run to growth for the U.S. So I think she's going to be a good. She's just going to be a person that everyone can listen to and trust, and doesn't come across as a hugely partisan person, even if she does have partisan tendencies. And I think she will work very closely with the Fed. In fact, one may argue that the Treasury has a chance of silently even taking over the Fed with Janet in charge. I mean, she's very well liked, very well respected, and I think the relationship between the Treasury and Fed could be as symbiotic or even as close as it was before the Fed Treasury Accord in 1951. So you've got a Fed and Treasury with a combined balance sheet that could work together in the event of any kind of downturn to sort of get Section 13.3 going quickly. There'll be no games like what Mnuchin was just playing with a few of the facilities in the last month. So I just think the backstop is very clear, and I think she'll be a good spokesperson for being sensible with fiscal policy, and that's a positive, at least in my book. So I'm excited about it. I don't think we know where the risk off comes from. We didn't know where it came from last year. Nobody had penciled in a virus except for maybe a few people that were watching China closely. Maybe it's geopolitical. Maybe it's something else along the healthcare lines. Maybe who knows what it is. But we get these bouts, and then we expect action. And I think we've got two people, Janet and Jay, who know how to deal with these unforeseen events very well. And that's a pretty much music to the ears of the risk asset markets.
David, one of the other trends that you've been watching that I've been living, as you and I have emailed about, is escape from New York, this sort of de-urbanization that we are seeing now in the wake of the coronavirus pandemic. And we've talked with a lot of people about this. What effect is it going to have on work from home dynamics? You're thinking about it sort of even bigger than that. Like, what effect is it going to have in a macroeconomic sense? So what do you think here as we go through the next 6 months, and you think this trend is really going to stick? And by the way, you escaped from New York as well, clearly, as we can see behind you.
Yes. Yeah, I made my escape about almost 5 years ago now when my last kid went off to college. But it does seem that the escape tendencies have gotten much bigger. Even before COVID, there was an escape tendency given the SALT changes in taxes and some of the difficulties people were having with higher tax rates, or just the disparities became very large. So I think Look, the point of the piece I wrote earlier this week, which honestly, I haven't even finished responding to the emails that I got from that piece called Escape from New York yet. I'm about halfway through about 150 emails, trying to get back to all the people that had comments or questions or observations. A lot of really similar observations, some different for sure. But I think the story is really a work from home story. That is, that if work from home becomes embraced the way I think it will, even if it's 2 days a week, even if it's three, or if it's more. But as people and executives get more comfortable with this idea that people can be more productive in their home environment, the potential cost savings are enormous. And we're seeing that in the margins on so many companies, particularly finance companies, finance sector companies like Jefferies, but many others. And I think it's just going to resonate with everybody that sort of knew deep down in their hearts that we didn't really need New York City. We might have liked New York City, it might have been fun, but as it becomes more and more expensive and the alternatives become more viable, I think you're going to see that exodus really accelerate. And I'm not sure where New York goes, but I did have the movie Escape from New York in 1981 as part of my metaphor in the story, which was a great movie. If you haven't seen Kurt Russell in his 20s, fighting through the streets of New York, you haven't seen anything that great yet. It's an amazing history. It's one of those great films that I loved as a kid. And remembering New York in the 80s, particularly the early 80s, it was just a very different place, but it had an edge. It'll come back. It'll come back differently, and maybe it just won't be the billionaire playground that it became. And, for someone like me, I'd say that's probably a good thing, not a bad thing. But then again, it's a very difficult place to raise a family and do what we've done in New York for the last 10 or 15 years, which is really gentrify it beyond maybe where that gentrification should have gone, or maybe was inevitably unstable given the political backdrop of a city as complicated as New York. So I'm bullish on the get out of New York trade. I don't buy the trade that it's all going to just revert right back to what it was like 9/11. I don't think this is a 9/11 storyline. I think there's something bigger, and a lot of it comes from work from home.
David, I certainly believe you that you got hundreds of emails, and I know I immediately reached out to you as soon as I saw your note. I do want to kind of talk a bit more about this, explore some of the macroeconomic consequences, especially when it comes to labor. I think you were also alluding to that, and also how it kind of plays into your views. You have these disinflationary views, and how this kind of plays into that.
Sure. I mean, it's pretty straightforward argument. If you're going to take, Goldman Sachs Asset Management or a big chunk of JP Morgan, or I think we've heard now that one of the Moelis is going to let its bankers kind of move anywhere and go and work from home. I would find it impossible to believe that some of that cost savings won't be shared some of it will be shared by workers, but by shareholders and those that own the business. So I think it's just a disinflationary story all around. It's expensive to live in New York. You're going to spend less on housing. You're going to spend less on food. You're going to spend less on daycare. You're going to spend less on education, commuting. And that even if you don't think there's wage disinflation, which there may or may not be, depending on how competition rolls, I think there's just the services that people use are going to cause disinflation numbers to become more prevalent as we move through time, and potentially even from a housing perspective, as we equalize out a city like Bozeman, Montana, or Boulder, Colorado, or Miami to some of the suburbs of New York, which are clearly much more expensive. So I think there's that is a disinflationary tone, and it's very much like some of the outsourcing disinflation that we got when we were taking businesses and moving them and offshoring them to China. We're sort of offshoring a bit of New York City into its own backyard in the United States. And that's just another disinflationary trend, which keeps me pretty excited about my disinflationary views. By the way, these are, and it's important to recognize, these are not negative disinflationary views. It may be negative for a few people that have high-end real estate in New York, but they're not negative from a growth perspective. They're actually positive, as we economists would call it, positive supply shocks. They make producing a widget cheaper, and the cost of production cheaper. That's really what work from home does. And the whole gig economy that we were talking about coming in over the next 10 years basically got forced in instead of in 10 years, in 10 months. And I think that's that's not just work from home, but it's all the technology that we've adopted. And it's a huge disinflationary impetus, I think, into next year and beyond.
And David, if you look at markets right now, look at DoorDash, Airbnb, the way those IPOs were received. You see all the SPAC activity happening. Stocks go up every day. Everyone's very excited about this next wave of innovation in the economy. And are you as excited, I guess, as financial markets are suggesting in those pockets? And how is that maybe coloring some of your views here as you look out longer term, right? What the next 10, 15 years, what the macro cycle of millennials getting older looks like?
Well, look, I think I'm not going to comment on any specific stock. That's not what I do for a living. I'm a macro guy, and I've always found, even going back to the 90s, I look back at some of the pieces I wrote back then, and it was very much a disinflationary technology view, and then I've added to that a demographic disinflation view that's really got me much more excited in the last decade or so. But I've always been a believer in that positive supply side shock story being the driver for business cycles. I'm much more of a supply side economist than a demand side economist. I never really got brought up with Phillips curves and Keynesian economics, taught at Rochester by a bunch of Chicago profs that were really, neoclassical in their beliefs. And technology was a big driver of business cycles for real business cycle theory types like the ones that were teaching me. So I've had that in my DNA for a long time, and it never went away. And it drove me to have big disinflationary views in the 90s, which were very counter to the views in the early 90s when the long bond was yielding 7.5% and the funds rate was at 3.5%, and everybody was thinking yields were going to go back up to double digits again. It helped me have a standout view back then on disinflation, and I think that is where I come into this year. I just still have that view. So it's very hard for me to see without a mistake, a financial conditions tightening that's executed by mistake and then gets rectified. It's very hard for me to see why we have some big yield rise, why we have some big sort of risk off move based on inflation scares. In fact, I thought it was funny yesterday. Jay Powell, not a lot of people picked up on it, but he was talking about how excited the committee was that inflation expectations from the TIPS market had now gone back to getting closer to 2%. And I think if they get up to 2.25%, 2.5%, they're going to be even more excited. They're going to say, "See, we can do it," because there's a lot of people out there that think we are Japan and we can't get inflation, and there's a risk of that, probably a bigger risk of that than staying with too high inflation. But I think. We have a very disinflationary storyline here in the U.S. We've had it. It's been in with us for decades. I know everybody in the bond market loves to talk about inflation scares. And honestly, I hope we get one. I hope a bunch of those guys come out of the woodwork and I get to fade them again, because it's been a great trade for 3 decades fading those guys.
Yes, you have been right. And there are a lot of people have been pushing for that inflation, calling for that inflation for a long time, who have not been correct. David Zerfos, that's one of the reasons that we love talking to you. Jefferies Chief Market Strategist, thank you so much for being here. Julia, thanks as always.
Not a lot of people have been correct in calling the action we've seen. Of course, not a lot of people could have predicted we would have seen a pandemic. But after we did get that news and saw the way it impacted the market, there have been few people more correct this year than Fundstrat's Tom Lee. Want to just spotlight what he's called this year in 2020. Back in the darkest part of the sell-off in March, when everyone was panicking, Tom called for a rebound to 2,800 on the S&P 500 by April and called for all-time highs in just 4 months' time. We hit 2,800 in April as he predicted. He said that confirmed the thesis, and the stock market would be back to the levels we saw before the pandemic, and that also played out. During the September sell-off, he called the line in the sand at 3,200, roughly about that. And sure enough, we bounced off that. And then finally, in the post-election sell-off, he said to keep your eyes on the VIX. If we hit 25, he said that the market would be overlooking those election challenges by President Trump. And sure enough, we did see that play out as well. So I want to bring on the man himself here with us in Fundstrat's Tom Lee here. We'll give the formal title, Fundstrat Global Advisors Managing Partner and Head of Research. And Tom, congrats on the great year, man. I mean, like I said, a few people have been as right as you, and I love your takes because they're all based on data and history and looking back on the history we've seen play out here. You're looking ahead to 2021, and you're saying the first half of the year might be a tough one for investors to stomach before we bounce back. So what should investors expect next year?
Well, I think that, as we look back in 2020, the world got lucky. And so stocks were able to look past a lot of bad things, but enough good things were happening for the market to rise. Those good things are getting stronger next year, Zach. Like profit margins are going to recover strongly. We should get a pretty big PMI boom. I think consumers are going to feel a lot of relief once we vanquish COVID. And if interest rates remain low, which we expect, then you're talking about a big negative rate environment while GDP is growing. And finally, the VIX, which you kind of mentioned, could fall even into the 17, 16 range. This really is great news for stocks. But I do think it's like 2020, it could be really tricky. And I think in the first half, we might make our way towards like the 4,000 level and then fall back to 3,500. And of course, you got to be ready to take advantage of that because that's not the end of the bull market. It's just the pause that refreshes.
There seems to be a key qualifier in there, though, that once we vanquish COVID, which is something that hasn't been done. Obviously, you look at a place like California, we've seen a significant uptick over the last 48 hours or so with hospital capacity now at 0%. When you look at where things stand right now, how much of this thesis that you've put forward is contingent on 75% of Americans getting vaccinated, as Dr. Fauci has said, that's needed for activity to resume to pre-pandemic levels?
Yeah, foremost, COVID's unpredictable. So, I have not been able to find a good way to forecast it, and we have not. And so to me, it is completely unpredictable. So you're correct. That's the biggest risk. But we also know that if you implement a strict lockdown, like Europe just did, COVID rolls over hard. So, it's not like the U.S. doesn't have options. Listen, you can't ignore what Fauci or Gottlieb say. These guys are experts. But one thing to keep in mind, it looks like if you tabulate the infections in the U.S. so far, plus make some assumption about unreported cases, we're already, we could be as close to 25 or 30% of Americans have been infected by the spring. And so then if we vaccinate another 30%, which is about 100 million, and that's a lot, that would be over what the threshold is considered for herd immunity. So I don't know, and I'm not an expert. And I think if we have a correction in the first half, it's probably because of all these unknowns that you and I just discussed. I don't know what COVID's doing, and it's still the dangerous virus. So I think everyone has to be careful.
Yeah, and Tom, to Akiko's point there, it's a big question mark. But when you look back historically, and we showed the chart here in terms of what to expect, we saw a run up here, 63% since those March lows. But when you look back at history, you're looking at a few years there in 2009 to 11, as well as back earlier in the 80s. So what does that kind of indicate in terms of maybe what investors should be braced for if we do get a bit of that correction in the first half?
Yes, the first thing I think to keep in mind is, it's going to be really healthy for stocks to get turbulent, but as we go through it, it's going to be terrifying. If we go down 15% or from 4,000 to 3,500, 500 S&P point decline, it's going to feel like calamity, and people are going to be raising more cash, and there's already $4.5 trillion of cash on the sidelines. So you can imagine a lot of people who've been sitting on the sidelines are going to say, I'm putting a vault, a force field around this cash. So you're going to talk about skepticism really growing. But that's how stocks can stage an even bigger rebound in the second half. So I think it's going to be healthy. It's going to be really scary. If I'm long-term focused, I wouldn't be a seller. But if I'm tactical, or if I had a ton of gains and then January we see S&P 4,000, maybe it's good to, have some dry powder. And, just another thing I'd point out, the expansion is going to be strengthening next year. So I think that the fear of calamity should be mitigated by the fact that we'll have more visibility.
Tom, when you look at the sectors you're overweight on going into next year, energy, one of those, and I am curious how you're looking at that space right now. Is it about the renewables or the clean energy on the expectation of more aggressive climate policies being put forward by the Biden administration, or is it more about tracking the bounce back as we anticipate the economies to open back up in a more significant way?
Yeah. Well, foremost, energy is our long shot top three. So we have three sectors we like, but energy is, I think, our longest shot. Maybe a bit, not a dice roll, but the one that you have to realize it could be the diciest. But I think it's a bit like cable or how wireless recovered. Energy has the supply and demand dynamics, and supply was a problem the last couple of years because so much drilling, and that's going to be slowing. And then in 2014, 2016, when the industry had financial trouble, there was all this private equity money that came in. So there was too much capital, but that's not coming in anymore. So you have two constraints on supply. And then demand should improve next year because of the recovery. And so you have a real improvement in supply demand. So less bad, as Tom Luddy, who was essentially CIO of JP Morgan Asset Management, always said, less bad is good. I think that's happening with energy, and that's kind of how cable and wireless really came out of their bottoms. So it's more the carbon energy that could do well. But it's a dice roll. Not a dice roll. It's the wrong word. It's not as clear cut as being long industrials or consumer discretionary.
Yeah, you've been pretty clear on your last appearances here. You like those epicenter stocks, as you talked about, some of those that have been most hard hit, whether you're looking at the restaurants, the casino stocks, airlines as well as some of the other ones you've highlighted there. But let's talk about let's continue the term of dicey roll here, because I think this one, I think we could both agree, perhaps a little bit dicier when we look at crypto. I highlighted a lot of the things you were right on there just to give the appearance of being fair here. There was one call when we chatted back in 2019 when we were talking about Bitcoin maybe potentially reaching 20,000 to 40,000 by the end of 2019, maybe a little early on that one, but we're there now. So what does the crypto outlook look like to you, and how investors should maybe be looking into the momentum that Bitcoin has behind its back?
Yeah, Bitcoin, if I had to say 2020, what has it brought? It's brought more relevance for digital currencies, because these are free from interference from government. They are fixed in supply, so they are not, hurt by central bank liquidity. And it's a way for people to protect assets, because I think there is a lot of insecurity about how safe the world is. So that's why we've seen some financial institutions and some really smart commodity and macro investors get involved with Bitcoin this year. I think it's really validated what the fringe would have always argued, that this is eventually going to be an allocated asset. We've always recommended 1% to be allocated to Bitcoin. I think it's too low. It needs to be a higher percentage. But 2020 returns are a lot like 2016. And that happened after the halving. So I think 2017, which was the year Bitcoin last went a little crazy, 2021 would be the year where you might see that in Bitcoin. So if anyone is interested, it's still quite early in Bitcoin, because 2017 the returns were astronomical for crypto.
I'm not saying it's going to 40,000. No, you're still is that still the target though, to keep eyes on 40,000 being the top?
Well, I think that the easiest way for people to think about the upside for Bitcoin is its displacement of gold. And gold is, $7 to $9 trillion of just above ground supply. And so that would put Bitcoin well above those levels. It's, a lot higher.
As we know, there is an awful lot of optimism out there. And our Emily McCormick is here with us now with one firm's bull case for stocks going into next year. Emily?
Well, Julie, of the dozen 2021 market outlooks from Wall Street firms that I've compiled so far, every single strategist believes that stocks are going to end next year higher than they are right now. Now, that said, some firms are more bullish than others, and the most bullish firm so far is JP Morgan. Now, that firm has set a price target of 4,400 for the S&P 500. They also see potential downside to 4,200, but upside to as high as 4,600. Now, that base case assumption, again, 4,400 implies appreciation of about 18% for the S&P 500 from its recent closing high of a bit over 3,700 from last Thursday. Now, for context, the median price target for the S&P 500 so far is 4,150 of those dozen strategists for 2021. And also, for historical reference, JP Morgan did see the S&P 500 ending 2020 at 3,400 in its call last year, and that had been right around the median of analyst estimates at that time. Now, looking ahead to 2021, JP Morgan's upbeat assessment is really based on a handful of assumptions. Some of the key ones are that central banks, including the Federal Reserve, will continue to tilt toward easy monetary policy, vaccine distribution will go smoothly, and that lawmakers in Washington will face a divided government scenario after those Georgia Senate runoffs in early January. So the outcome of those elections is still a possible downside risk here that JP Morgan had cited, but we will be getting some clarity on that within the next month or so. Now, a key quote here from JP Morgan really sums up their outlook. The analyst wrote, quote, "The equity market is facing one of the best backdrops for sustained gains in years. After a prolonged period of elevated risks, global trade war, COVID-19 pandemic, U.S. election uncertainty, etc., the outlook is significantly clearing with the business cycle expanding and risks diminishing." Now, they also added that they expect a, quote, "market nirvana scenario for equities with a melt-up especially happening in the first half of next year." They said over the longer term, gains may be a little bit less pronounced in the second half of next year as the Federal Reserve potentially starts to give guidance around tapering for some of its highly accommodative policies during this crisis scenario here with the COVID-19 pandemic. But overall, a lot of bullishness here for Wall Street as a whole, and especially with JP Morgan. Julie?
Joining us now for that conversation is Eric Winograd. He is a senior economist, fixed income, over at AllianceBernstein. Eric, great to talk with you this morning. So let's begin with the news that we got, or we expect to get later today, of a stimulus bill actually passing and getting some of that aid that we've expected and many have called for the last few months. Was this kind of your base case thinking about 2021? Is this maybe going to boost that outlook? And how do you expect this additional money into consumers' hands to change things as we get into the first half of next year?
Yeah, Miles, thanks for having me. Certainly from an economic perspective, I think it's good news that we did get some stimulus. I would argue that had already been well priced into the market. And if anything, I think probably a slightly larger package had been priced in. Recall that before the election, most in the market were talking, and certainly people in Washington were talking about a bill that might have been $2 trillion or perhaps even more than that. So, again, 900 billion, it's hard to keep track of just how large these numbers are. $900 billion is a lot of money. Better late than never, I suppose. And so it is certainly good news. I think it is important for those people who have lost their job to receive continued support. And it does brighten the outlook a little bit for next year.
And so,
Eric, Miles and I.
Sorry, go ahead, Seth.
No, I was saying, Eric, Miles and I were just talking about the outlook for inflation, and that talk is starting to pick up on Wall Street. How serious is that inflationary talk right now on Wall Street?
So I heard you and Miles talking about that, and I'm on his side, not yours, Saz. I think that the idea of inflation picking up next year in a way that requires a Fed response is a very distant prospect, and I think that the market generally understands that. It's not that inflation might not pick up. I think that as the economy improves, it probably will. But the change that people need to recognize is that the Fed isn't going to respond to that. And if anything, they're going to encourage it. The Fed wants inflation higher. And so I think it would be a mistake for the market to see prices rise and then conclude from that the Fed is going to act.
So, Eric, you probably heard then some of the risks that Brian was talking about to the equity markets potentially going into next year. What do you think are the biggest risks for fixed income? I mean, we talked about the possibility as well that there could be another aid package, especially if the outcome of the Georgia election is to add a couple of Democrats to the Senate. How are you thinking about that likelihood and what happens on the policy front next year?
So certainly the biggest risk to fixed income, the thing that is most likely to make rates move higher, is the idea that inflation expectations will go up and the Fed won't respond. That's how you get a much, much steeper yield curve, right? Historically, Saz is exactly right, that when prices go up, the Fed does respond, and that limits the extent to which you see an increase in yields. But over time, if you have a situation where inflation rises and the Fed doesn't respond, then from a fixed income market perspective, that does argue that the yield curve should steepen, which is in fact exactly what we're expecting. I don't think the Fed is likely to raise rates at least until 2023 and probably into 2024, even if the economy recovers. And I do expect a strong growth year next year. So if you get strong growth, some rise in inflation, and a Fed that doesn't respond, then the risk of a steeper yield curve mounts. Offsetting that, of course, is that the Fed is still doing quantitative easing in large size, and that will act as a restraint. But I think what we heard from Chair Powell last week is that they might be willing to stop QE long before they raise rates. And once that happens, the scope for long-dated rates to rise would be meaningfully higher.
You know, Eric, years where the Fed is talked about a lot, 2018, to a lesser extent 2013, but 18, 2020, those are years that investors don't really want to remember all that much. They were tough years overall. Do you see the environment going back to this kind of close reading, Fed watching, where everyone's parsing individual words, but the average investor isn't seeing blaring headlines about Fed this, Fed that, the way that it played out in March and April? And do you see kind of focusing on the Fed becoming a more boring sport, as it were, as we get into next year? And all else equal, that's probably positive for markets.
It should, right? If the Fed does their job correctly, if they communicate what their actual intent is clearly, they should be more or less out of the game for next year, right? We have more clarity about the economic outlook than I think we've had since the COVID crisis started. Things look a little bit better than they have. The Fed really shouldn't be in the picture. My fear is that because the Fed's communications have been so vague, because they have been unwilling to be specific about what they mean in terms of the average rate of inflation over what time horizon, how much over 2% are they willing to tolerate, for how long, that runs the risk that the market will do exactly what you say, Miles, and start to wordsmith it again. And every time Chair Powell speaks, the market could say, oh, no, does that mean that they're closer or further away? I firmly believe that they are a very long way away from tightening policy. But I think that it would be helpful for markets and for the economy for them to be a little bit clearer in the way they communicate that. I do think the market is going to test them at some point next year because they've left themselves a lot of wiggle room. And the market is going to say, OK, what does substantial mean? What does significant mean? What do all these little words mean? And if the Fed answers those questions correctly, then they should be able to put it on cruise control for the rest of the year. If they don't, then it increases the risk of volatility that wouldn't be helpful and, at least in my mind, isn't necessary.
Yeah, the old 6 months slip, I think, was the first thing that
right.
Janet Yellen screwed up back in 2014. Right. All right. Eric Winograd is a senior economist for fixed income over at AllianceBernstein. Eric, great to speak with you this morning. Have a great holiday and Happy New Year.
Thank you. Thanks for having me.
Taking a look at the market, though, today, we can see the COVID headlines are dominating with all three of the major averages still in the red. For more on this, we want to bring in David Bansen. He is the Bansen Group Chief Investment Officer. David, great to have you on the show. Let's just start with where things stand at this point. What's your take on the losses that we're seeing today and the fact that COVID seems to be dominating the progress on the stimulus?
Yeah, it's very difficult for me to comment on a 100-point drop after 6 weeks of a 4,000-point increase because it leaves you without a real clear explanation as to causation. I think that this morning's jitters are very likely around some of the COVID headlines overnight in the UK. But of course, those headlines were there all day yesterday as well. And the futures were up a couple hundred points last evening. So I think that it is sort of a regular market, just sort of gyrating a bit. It's a bit overbought and there's some degree of recalibration. But to the extent that people might be wondering if there's some really, really bad news coming on COVID, it doesn't seem to me like 120 points would be the response to it. Energy has been rallying dramatically, and it's checking back a little today. The financials are actually doing quite well in response to the Fed ruling on Friday afternoon. So there's just normal market activity taking place, and it'll be interesting to see how we close out the year.
David, Brian Chung here. I want to ask you about what's going on in fixed income markets. You kind of rightly point out that when people are talking about, oh, there might be a breakout in the 10-year yield to 100 basis points, it's still an extremely low yield environment. But we are still seeing some of those, at least with the maybe sell-off muted a bit this morning, that people were going back into U.S. Treasuries. What does that tell you about the strategy broadly in the market for trying to buy capital appreciation in this type of market?
Well, anyone who's trying to buy capital appreciation won't be buying treasuries. And so to the extent that you get an inevitable movement into safety at different points, sideline money that finds its way into treasuries, there's so many different things that, particularly on the sovereign wealth side, that will move the longer end of the curve. But primarily where people are going into capital appreciation is U.S. equities and only U.S. equities. I mean, even with the incredible return in emerging markets this year and the weakness in the U.S. dollar, you're not seeing the flows into emerging markets equity you would expect. So for whether it be fixed income or some of the other alternatives, that quote unquote TINA trade or perspective on U.S. equities, there is no alternative, especially when the objective might be capital appreciation. That's really the only place people can go. The issue will be where they go to get it within U.S. equities. And that sector rotation that has played out rather meaningfully over the fourth quarter, but would still only be in very, very early innings in our mind. We would be very much in the camp going into 21 that rotation that's been long awaited by so many into value and out of really very frothy growth is about to play out.
Well, David, speaking of that rotation, then where are you finding some opportunity? Is it on a sector basis, or are you drilling down and really identifying specific names within those sectors?
Yeah, we are very bottom up at my firm. We are dividend growth investors. And so a little bit over half of the $2.5 billion that we manage are in dividend growth equities. And so that by definition, that's a very bottom up formulation. But the truth is when you're done with your security selection, you end up with a sector allocation. And the sector allocation right now, I think, is resulting in heavy weights in energy, financials, consumer staples, some of the sectors that you talked about being most vulnerable or weak on a day like today, and we like it that way. Where we're not finding a lot of value, just in terms of the valuation metrics we use, let alone dividend aspirations, is obviously in the FANG type names and what we call cool tech, the kind of newer, bigger, shinier objects in the technology sector. Old tech is where you can find really good dividend growth and really good value. Intel is very, very cheap right now. Broadcom has had an incredible run. We made over 100% on Broadcom this year, but even then it's still yielding well into the threes and had been an over 4% yielder. That's hard to find in technology right now.
And David, it sounds like if that is an endorsement of maybe a value play right now, what's the time horizon for that? Obviously, a lot of people can't even imagine the world in 2021, 2022. If you are making those types of plays, how long are you designed to be holding those if you're making that play?
Yeah, I'm probably the wrong guy to ask that just because we're not, it's not a play for us. It's a very secular perspective. We have a permanent bias towards good valuation, and we just recognize that there's certain periods in which valuation becomes incredibly unimportant to investors. And obviously, we've got a chance to see some really great returns in large cap technology growth because of that. But no, for our perspective, we want to permanently be invested in companies we think are at good valuation, and we measure that through their cash flow generation and their cash flow growth. And then, of course, the portion of that cash flow that they're going to share with us as investors in the form of dividends. So we are in that trade, so to speak. We will be in that trade well beyond 2021.
David, taking a longer term look here at the markets, absent COVID and the stimulus talks, what do you see as the potential headwind here or biggest challenge for investors going forward into next year?
Yeah, it's a great question because I think there's two categories we talk to our clients about all the time. One is the stuff you're really supposed to be scared about, which is by definition stuff that you don't know, the stuff I could never answer. There's no way 1 year ago at this time I could have been forecasting what the COVID pandemic would end up looking like. So I think the biggest risks are always those quote unquote black swans that therefore are by definition unhedgeable and that you're reasonably indefensible against. And that reality as an investor is why we do asset allocation. Now, in terms of things we do know about that are just out there and people have to be aware of and hopefully incorporate until they're into their active portfolio management, I think that the risks with China are never really fully appreciated. I think a lot of people just assume with the new Biden administration there'll be a rosier relationship with China. I think that presupposes that China's up to good, and I don't think they're up to any good. So I would always be cognizant of weakness there. I never know if the banking system in Europe is going to stay alive for another week. And so those type of risks are out there. But as you point out, the things with COVID, stimulus, if every single man, woman, and child in America is talking about it, it's probably not the biggest risk in markets.
All right, David Vanson, the Vanson Group Chief Investment Officer. Great to have you on the show. Thanks for joining us today.
Thanks for having me. Merry Christmas.
We're joined now in the stream by Tiger 21's chairman, Michael Sonnenfeld. Michael, thank you so much for joining us.
Thank you. Great to be here.
Well, let's start with where the folks in Tiger 21 are putting their money, some of the changes that you all saw based on a member feedback questionnaire. Real estate, private equity, those seen, I guess, put that in context for us, where they've seen more gains in 2020. Where were folks putting their money?
Sure. So just to put a context, today we're about 850 members. So you're looking at about 85 billion in assets in what you're recording. And this year was a year of huge change. Earlier in the year, in March, cash skyrocketed from 12% to 19%. We'd never seen anything like that in over a decade. And now it's fallen back down to 16%, meaning people are getting more confident. They're not highly confident, but things are stabilizing a bit. And over the year, they did make changes. They liquidated first the public equities because those were easiest. But as things stabilized, started tiptoeing back into real estate and private equity, because that's where our members created their wealth, so they can spot a great opportunity when it happens.
So Tiger 21, help us understand. We've all had mentors, but Tiger 21 teams people up who are high income or net worth individuals. Break that down for me. Are we talking people with an income of $250K a year? What's the definition? No, and then how does the network come together to help?
It's post-income. Our organization is for entrepreneurs who have had a liquidity event, generally sold their entire business, been bought out of a business. They've been running it 20 or 30 years. We manage, our members have between 10 million and $1 billion of net worth. They're no longer earning salaries because they've sold their business, and they come together in groups, 70 groups across the globe. It's the largest network, and we're part of what would be called peer-to-peer learning. So when you sit in a group with 12 or 14 people of relatively equal success, and by the way, that level of success is just like being in the major leagues. In the major leagues, football, baseball, basketball, you're 1 in 17,000 by accomplishment. To be in Tiger 21, you have to be 1 in 10,000 by accomplishment on average. And you're learning from people who have sold businesses before or will be selling businesses. And we're big believers that experts are important, but you could keep experts on tap. The real learning comes from somebody else who's sitting in the same shoes that you are now, or maybe they already sat them and figured out how to go.
So, Michael, I imagine you have a very unique insight into what the ultra wealthy are doing. We keep hearing or seeing headlines around exoduses from states like New York, California, people relocating to Austin, Miami, other places like that. You all did ask a few questions about folks. Have they changed their primary residence, I suppose, during the pandemic? And would they consider changing if their taxes went up? Help us contextualize. What is the trend? Is there a trend? And what are you kind of hearing from your members as it relates to some of these things?
Sure. It was an amazing survey that we just did of our members. And basically, members started saying when tax rates change by more than 5% within a state, as happened as an example when they eliminated the deductibility of state and local taxes, they're going to start moving. Sometimes it's just economic, and sometimes they feel like the money is being wasted. An example that comes up constantly is if you could have paid the $3 billion subsidy that would have got Amazon to come to New York, nobody talks about the $20 billion in benefits that were lost. That would be a good tax expenditure by most of our members. But when the money is spent in ways they don't believe is productive, they start really wondering whether they're getting value for money. It's not all people. Many people love where they are, and for a few extra bucks, they're not going to move. But you have this train from California, Silicon Valley to Austin that you read about, from New York to Miami. And clearly the pandemic accelerated what began with the SALT deductibility elimination.
I think a lot of people, Christmas on Friday, let's look into 2021. And in your latest note, you tell your clients that the base case scenario for GDP growth next year is going to be that we hit the previous peak in the U.S. economy in the fourth quarter of 2021. What could derail that?
Well, what's interesting about that is with the assumed stimulus that we got. It's a little shy of what we didn't put all of what we got in there. So we'll be boosting that a little bit, but still the timing is late in the second half of 2021. And what's important about it is a couple of things. First of all, the good news is there's a vaccine out there. There's a timeline on the vaccine, give or take a little bit. That will mean at some point in time, we will be able to unleash the pent-up demand that we've had. That is barring, of course, any mutations that render the vaccine useless. Hopefully that doesn't happen. We're not looking on the downside. I'm just trying to stay focused on the light at the end of the tunnel right now. But I think it's important to remember that once we hit that previous peak from the fourth quarter of 2019, that's 2 years after we hit that previous peak. And that is something that I think many people don't realize is we're that far behind from where we were, even as we unleash pent-up demand. And then from there on, what matters is the pace of growth. Can we recoup not only what was and what we lost to the crisis, but also what could have been? By February, we will have lost 2.3 million jobs that we would have been generating if we had not had the COVID crisis. And that's often lost in translation, that we don't need to just regain the 9.8 million jobs that we've lost as of November. And those are only the ones that are on payrolls, not self-employed. But also we need to replenish and get on a trajectory of growth that reestablishes where we were prior to the crisis. And that's a much harder and heavier lift.
Diane, it's Julia LaRoche, and you're talking about the need to reestablish growth here, and also that the stimulus here was shy of what was needed. I guess maybe a better way to characterize it is more relief rather than stimulus. So let's talk about what is needed to get us back on growth, what is needed to really stimulate the economy. How do you think we can get there?
Well, the one thing that was encouraging in the package, there were several encouraging things, and we are glad there was relief. And you're absolutely right, it's really more relief than stimulus. But there also was funding for schools, both K through 12 and higher education, some $80 billion in funding for schools. And that's really important because 1 in 4 students don't have access or the ability to get online education. And the online education that they were getting was not as good a quality. We know that from testing already, from what we've already been through. The online schooling wasn't as good as what they had in person. And so they're actually losing educational attainment. There's going to need to be catch-up courses over the summer. What's good about this is that there is some funding to the states through those means, that we could rehire a lot of teachers that we've lost, or hire up where teachers have resigned and not gone back into the classroom. They've taken early retirement or the retirement that they were due because of fears in going back into a classroom in a COVID environment. So I think that's important. But going forward, after we unleash pent-up demand, we know that we've got a headwind from state and local governments, and that's a minimum of $200 to $400 billion, between $200 and $400 billion alone from state and local governments. And they're one of the largest hiring employers out there. And to see that absent as we're getting into a more sustained recovery, that could really set us back. And that's what we're worried about at this stage of the game.
And a second part to Julia's question, which what we're not saying here is kind of the income inequality of this pandemic, that the rich have gotten richer and the middle class and poor, in some cases, have gotten poorer. You even point out that the pace of the rebound depends on how much consumers are willing to deplete what has been, $1.4 trillion in savings. And you're worried, if that's the right adjective, on big ticket spending and house renovations slowing down. Why should we share your concern?
Well, what we've seen is a lot of that movement was the spending on goods, on everything from cars, luxury cars, to boats, to second homes, vacation homes, and upgrading homes for people to work from home. That's already occurred. And as we move back into the workplace, although work from home will likely become a more permanent part of it, it won't be the only place. We're human beings, after all. We want to congregate again. And so that will shift spending away from some of these areas. We've seen spending strength from high income households, but also, as you mentioned, the break between the unevenness. COVID has exposed and exacerbated inequality in a way that's very important, because we know that more unequal growth means the overall economic pie, the whole, the sum of its parts, is not as great as it could be. It's not just, that if the haves do better, that the have-nots and leave the have-nots behind, the haves are just fine. Everyone does better when we grow the overall economic pie more evenly. And I think that gets lost in translation a lot, and that's something we're very concerned about. And we've already seen how many low and middle income households have really been hit very hard by this crisis. Well, people who were able to sustain their incomes and continue spending, they'll be shifting into other areas of spending, but they alone, a rising tide, the spending they do on discretionary services cannot lift all boats.
Diane, I want to broaden the conversation out and talk about global growth, trade, and the impact there. And of course, the conversation just over a year ago, it's amazing how fast time goes, was about trade and trade tensions between the U.S. and China. And as we have a new administration taking shape now, what do you think that outlook looks like?
Well, I think we're going to see more collaborative approach to trade, with the exception of China. I'm not sure that we'll see a lot of light between administrations in terms of China. I think tensions with China are going to remain extremely heightened. And what we've seen is some pivot of trade to Vietnam, not coming back to the U.S. soil, but just changing which country we actually see trade coming from. Large companies were able to pivot to Vietnam. Other companies have pivoted towards Mexico, where we do have a trade agreement. I do think from the incoming administration, we're going to see more effort to collaborate with our allies in trade and actually try to isolate China more. That's originally what the Trans-Pacific Trade Pact, way back when, which was thrown out by this administration, was designed to do, was isolate China and use the peer pressure of the rest of the world to get China to play more by the rules of the rest of the world, especially the developed world. And I think you're going to see more collaborative efforts on that front. That said, let's face it, the first reaction, the first recoil to COVID was to exacerbate the idea of pulling in rather than pushing out on globalization. As people talked about regionalizing supply chains, that doesn't mean a supply chain is necessarily safe in the U.S. relative to someplace abroad, because of course we know as we locked down in the spring, it was occurring in different parts of the U.S. at different times. But I think it's also important to understand that regionalizing doesn't necessarily mean bringing it back to production in the U.S. either, nor to Europe. And those are both of the themes we're seeing played out, that trade tensions are going to remain with us for some time to come. And they become a catch-all rather than really dealing with the shortfall in education, the shortfall in training, which have all been exacerbated by COVID, race and gender inequalities, all of those things that have been exacerbated by COVID. And we could use COVID as a catalyst to deal with those inequalities rather than just sort of keep turning on a blame game and looking external. We need to look at ourselves in the mirror and find out what we're doing wrong.
Stocks are on track to close this year with double-digit gains. Traders shaking off the turmoil that we have seen this year. But what are some of the top risks that they are looking for going into 2021? Emily McCormick is joining us now. Emily, we've seen a lot of bullishness, certainly, heading into 2021. But what are some of the risks to be aware of?
That's right, Julie. Definitely a lot of optimism on Wall Street heading into 2021. But of course, there are still some risks that strategists have been highlighting. So I took a look at a dozen 2021 equity outlooks from strategists, and three key risks really kept coming up as possible obstacles to next year and potentially another year of double-digit returns based on many of their base case scenarios. Now, the first risk is around the vaccine rollout. Now, just taking a look here at the S&P 500 performance since November 9th. That's the day that Pfizer and BioNTech really first announced that very upbeat vaccine efficacy data. Stocks have already risen more than 5% since that date. There are some concerns here that perhaps the vaccine optimism is already priced in, so it does leave some potential downside risk here in the event of any hiccups in that rollout. So that could be things like issues with distribution, with not having enough vaccines to actually confer herd immunity to Americans as a whole, on the whole of the population. So that is one of the large risks for next year, and one of the obvious ones that investors will be watching. Now, the second one is actually around Washington, and that has to do with the outcome of the Senate runoffs in Georgia. Now, most of these strategists had priced in the outcome of a divided government heading into 2021. They assume that that will be the outcome after these January runoffs, but that is something that does still hang in balance as we look at the polls over the past couple of weeks. That spread really, and the advantage that Republican incumbents have had, really is starting to narrow here. So that could be something that is also a downside risk to stocks and could potentially trigger a knee-jerk downside reaction in the event that Democratic lawmakers do come out with having a majority in the Senate chamber at the end of that election. Of course, at the same time, there is some possibility that another stimulus package could be passed in the event of that. So that could take off some of the risk there. But again, potentially a knee-jerk reaction around that. And then third of all, there are some risks around firming rates next year. Of course, we know that the 10-year yield and treasuries as a whole have really been under pressure this year. Some concerns about liquidity tapering, as JP Morgan strategists had put it, and the possibility that the Federal Reserve may start to signal that they'll be rolling back some of their crisis era facilities and some of the monetary policy that had been so highly accommodative during the coronavirus pandemic. So any signaling of that, possibly in the second half of next year, will be something that traders will want to watch. Julie?
So, Emily, we're talking about the risks that exist out there in the outlook, but I know a note that you're looking at that caught my attention as well. Savita Subramanian over at B of A, relatively cautious compared to a lot of her peers, looking out to next year. And I know B of A tends to do the upside base case and downside scenario, and not great on the downside there.
That's right, Miles. I mean, actually, with the downside case for Bank of America, they actually predict that stocks could potentially actually see a negative return next year. So that's something that we don't necessarily want to see. But their base case is still for 3,800. That implies upside of about 2% from the S&P 500's recent closing high of 3722 from last week. Still, that would be quite a step down from the 14% rise the index is tracking towards for this year. And by comparison, of course, that median forecast from those dozen strategists is 4150. So quite a step down from that as well. But really, Bank of America's outlook is based on the fact that they do believe that the recovery is intact and the world will reopen in the second half of next year. But they fear that a lot of the optimism is already priced in around the vaccine and the recovery in the economy and corporate profits. They mentioned, quote, a simple move in the equity risk premium back to the prior decade average of about 500 to 550 bips versus the current 437 bips would drive the S&P 500 down to as low as 3,000 or 3,050. So some possible risks here, but overall that base case still does imply a positive return for next year. Miles and Julie.
Which does seem to be the consensus, doesn't it? Emily, thank you so much. Always good to keep an eye out for some of the risks in the market.
Matt Maley is the chief equity strategist over at Miller Tabak and a managing director. Matt, great to talk with you this morning. Let's begin with your 2021 outlook and a note you sent over saying that you've become more cautious on the market next year. What are you seeing when we see the stimulus come through today? We had a guest earlier say the recession or double dip recession is now canceled as a result of that. But what kind of backstops your caution here as we get into next year?
Yeah, I mean, one of the things that I'm not so worried about a recession. I'm just worried about how expensive the stock market has become. You know, it's interesting, but the addition of Tesla has actually made it a little bit more expensive. So now it's the S&P is now trading at about 22.5 times earnings. And the thing, though, for me is that people keep talking about, hey, growth rates are going to be great next year. We're going to see a big jump in GDP year over year GDP growth. Earnings growth is going to be really strong. Some people saying it could be even as high as 20%. Well, that's great if you're comparing it to 2020, which was a horrible year. But we really need to compare it to pre-pandemic, because that's where the stock market was trading. If we were going to have year-over-year growth and the stock market was down, that would be great. Okay, but my point is that we have a earnings growth. I'm sorry, the GDP growth was only mediocre pre-pandemic, and we're lucky to get that by the end of next year. And earnings growth at even 20% year over year, that only takes us back to what we had in 2019, which was no better than 2018. In other words, you're going to have flat earnings growth over a 4-year period, and yet the stock market's 30 to 40% higher. And that's why the PE ratio, of course, is so high. So my point is, we're going to need a lot stronger growth than just better growth in 2020. We're going to need better growth in 2019 and 2018 to take the stock market a lot higher from here. That doesn't mean the stock market is going to get crushed or we're going to go into a bear market. I think we'll be likely to get a deep correction, but those was what we get in most years, anywhere from 10 to 15% or even close to 20%. That would be normal and healthy, not the worst thing in the world. And I do think that overall it's going to be a relatively flat year by the end of the year, but there is going to be some opportunities to buy, I think, certain groups in certain areas where people will still be able to make some nice profits.
Matt, if I could put you on the spot here, it's Julie. Is one of the things to buy Bitcoin? You just heard our guest talking a little bit earlier about what she is expecting for 2021 and kind of explaining the move that we've had this year. Is that, I mean, if we're not going to see amazing outperformance next year in stocks, is that one of the places people should be putting their money?
Well, I think Bitcoin is going to be. I love it long term, and I think it's going to go a lot higher. But investors need to be careful right here. I just think, again, if you're a long term investor, I'm not saying sell it to, maybe you can take a few chips off the table. In fact, I still think it can rally a bit further and get up, into the high 20,000s. But I do think it's becoming very, very vulnerable to a significant pullback. Your previous guests had talked about how volatility is way down. That's like saying that the Jets are a great team because they won one game. I mean, I just think there's a lot of volatility left. It's the most overbought. It's getting very close to where as overbought as it was back at the 2017 highs. I don't think it's going to have the same kind of correction, but I also believe that the liquidity that's being put into the market, which I think is going to be a little less plentiful after we get past this most recent cold weather and the most recent strain of the most recent wave of the coronavirus. Then what's going to happen is, remember, over the summer, when you get that real excess of liquidity, it goes into a narrow number of things. It was all those high-tech, mega-cap high-tech stocks. Well, guess what? It's no coincidence that when those stocks started to flatten out back in September, that a couple of things like Tesla and Bitcoin suddenly shot up. So there's a great fundamental story, but it's also a liquidity-based story, the most recent rally. And when that kind of dries up, I think the thing can easily pull back 30%. So I'm not looking for the same kind of decline we saw after the 2017 top, but I do think we'll have a better opportunity to buy it at some point next year, a much better opportunity.
Matt, you struck me as a little bullish on Apple in your morning note this morning. If you had to bet your life savings in 2021, Apple or Tesla, that's better stock to own.
Oh, Apple, absolutely. It's first of all, again, it's a great company. I mean, if Apple is serious about getting into this automotive business or the smart car business, that's a big problem for Tesla. I mean, we just got a little news. They've talked about it before. This one seems to be a little bit more serious. But Tesla, we're not buying Tesla because it's a car company, of course. We're buying because it's a technology company, and there's nobody who can compete with it. Well, if Apple becomes a major competitor, with all the money they have, I mean, the amount of cash they put off every year, that's going to be a problem. But much more importantly, I just think that, again, Tesla has been moving up lately because of this issue of liquidity into the marketplace, where Apple has still got a much stronger fundamental base. So I'd much rather own Apple. Tesla, I'm not saying Tesla should short it. I'm not a major bear on Tesla. I just think they got some issues. And if Apple really starts to compete with them, that's going to be a big problem.
Matt, I just want to go back to the thinking about the broad market next year, and an interesting dynamic that some analysts have flagged, which is that earnings growth may broaden, but because of the market cap construction of the S&P, the index might not go anywhere, right? If Apple doesn't go up a lot and Tesla doesn't go up a lot, you could have bank stock go up 30%, but that might not really push the S&P all that much given the weighting. Is that something you're on the outlook for next year? This sort of good sectors are really good, but the overall market is flattish because of the distribution of some of those gains.
Exactly. It's one of the things I still think a lot of money can be made. I mean, the bank stocks. I think one of the previous guests said they're expensive. I'm not really sure where they came up with that. They've had a nice rally here. That doesn't make them expensive because they were incredibly cheap for a long time. But the reason is they were cheap for 3 years, and I was very cautious on the group because of the way the interest rates were. And interest rates, if interest rates skyrocket, now we know short-term interest rates aren't going to move. The Fed's told us that. But long-term interest rates have been moving up, and if they skyrocket, that's going to be a big problem. But I don't expect that. I expect just to creep a little bit higher. They get up into into the low ones for the 10-year yield, especially if we get the yield curve, which has been steepening. Again, it's the 2 to 10-year spread is only 80 basis points, but that's a lot higher than it was before, and that's very bullish for the bank stocks. So my point is that you finally got a cheap group that has something on the interest rate side of things that's going to help it make even more money. This is a group, again, it's getting a little overbought near term, and it could see a little bit of a pullback. But I think that they will outperform as we move through the year, especially with the new announcement on buybacks, and as they get further into the year, they're going to be able to do more of that and with dividends and things. So that, and I also think the energy sector. You had the recent comment on Exxon, and I agree with that. Exxon, they've got their issues, but if you get some of the smart stocks in that area, they're still trading like oil's in the low 30s. Oil doesn't have to take off for this group to do better, and I'm a bull on commodities in general. So I guess my point is stock picking and group picking. People can still have some real nice returns next year. It's just not going to be as good if you're in an index fund.
In aggregate, income did not fall for the economy as a whole because of the CARES Act. Now, of course, there were individuals who've seen significant declines in their income, and the increased unemployment insurance benefits or the augmented unemployment insurance for people who are self-employed did not give them enough cover, but it gave enough that we didn't see a big decline in income due to the COVID recession. And maintaining that is really key to making sure that once we actually get a handle on the virus, once we have people vaccinated, we can have the capacity to bounce back. Of course, this has gone on much longer than anybody anticipated. And one of the striking things to me in this bill is the sort of implicit assumptions that by March, by the middle of April, everything will be fine and we'll be able to go back to normal. And what we see, and I think one of the reasons the market is down today, is that this virus is very pernicious. We have this potential mutated strain in the UK. And I think this has people very, very nervous that we don't have a demarcation line when we know we're going to be able to get a handle on this by having everybody necessarily vaccinated, because we now don't know, are these new strains somehow more resistant to vaccines? So a lot of question marks that I think has the market very concerned.
Constance, this is Emily. On the point of stimulus, the enhanced unemployment benefits and direct checks that are coming through with this package, should we expect to see more discretionary spending happening among consumers? Are people going to be buying more clothes and electronics in a way that might meaningfully buoy consumption and those retail sales figures? Or are these payments really just going to fill in necessities like rent and medical bills, or go back into savings like we saw in the spring?
Yeah, a great question. So one of the themes that we've been talking about is the impact of what economists call loss aversion, and what we've termed FOGO, fear of going out. So normally a lot of our consumption is motivated by FOMO, fear of missing out, right? We don't want to miss the concert or the baseball game or the birthday party or even the work conference, right? So that motivates us to do a lot of our spending. And what's happened during the COVID recession is that we've been confined to our homes. We have this fear of going out. And so we want to consume things that make that experience of being at home a little more enjoyable. And one of the things that economists are concerned about is, there's only so many fire pits and Pelotons that you're going to buy, right? So a lot of this goods consumption, brought forward consumption, we don't expect that to continue at the same pace into the second half of this year or the beginning of 2021. And you bring up a good point. This is likely going to go to more necessities because part of the economy is open. But understand that a big part of the savings increase is because we just can't consume things that we used to consume. They're not available to consume, and that's a lot of the services sector. So to pull it back to your question, I don't see apparel consumption going up until we can go back out and do things, for example.
Constance, Brian Chung here. Great to speak with you. I want to ask about broadly what we might expect for Fed policy. We got a third estimate on third quarter GDP this morning, 33.4% on a quarter over quarter annualized basis. That's a slight revision up from the 33.1% that we saw in the second read. But I guess just broadly speaking, we had expected that to be a pretty big rebound. It's really the fourth quarter that's going to tell us where we're going from here. So as we look into 2021, the Fed's got zero rates right now. It's been offering a little bit more forward guidance on quantitative easing. But what do you think is going to be the biggest story for the Federal Reserve as we kind of hit this inflection point where the virus cases really surging, but that vaccine on the horizon?
Yeah, so I'd say there's sort of two scenarios. If we can get to a place where we reach herd immunity, where we can start going back to our normal activities, where FOMO activities can really resume in force, and you see a big part of that services consumption come back, that's going to bring back jobs. It's going to be a positive virtuous circle, and we might actually get some of the reflation that the Fed has been hoping to create as a result of their policies. And if that can really happen and really take hold, and if the recovery can be broad-based, and this is a really important shift for the Fed really realized that had they been slower to raise rates coming out of the global financial crisis, we would have seen a broader-based recovery sooner. And so it's that broad-based recovery that the Fed is really looking for. Many have termed this a K-shaped recovery. So those that can work from home are continuing to be employed at a much higher rate than those that have to work at their job site. Obviously, we still are 3.8 million leisure and hospitality workers below where we were in February. And those people really don't have jobs to go back to until we get a handle on the virus. So a lot of this depends on how broad-based the recovery is. But if assuming we can get some reflation going, then that would mean they might start jawboning down some of the, or they might start changing their language and changing their asset purchases so that we can have slightly tighter monetary conditions going into 2022. But I would not look for a base rate hike really for another year and a half.
And Constance, to that point about the broad-based economic recovery, there have been clear areas that have already rebounded faster than others. Like housing has been especially strong, and manufacturing has been stronger than services. Do you think there's going to need to be some moderation in these stronger areas in order to lift up the services sector and other parts of the economy just as a function of redirecting wallet share? Or do you think some of these stronger areas are going to continue outperforming for a while now?
So if we look at something like housing, for example, housing is traditionally a leading economic indicator. In the global financial crisis, it wasn't so much. But normally, housing falls before a recession, a leading indicator that a recession is coming. And then the Fed cuts rates. We see it's a very interest rate sensitive sector. And it usually starts rebounding before the recession is over. And what it does is it creates a positive virtuous circle of spending. So if you're buying a new house, for example, you're buying new furniture, you're buying new services for that house. And so it causes other spending within the economy and it helps the economy grow. And so we expect that to be a significant part of the virtuous circle that can get ignited once we get a handle on the virus. But of course, we've had such an extreme rebound that it does make us wonder if we've brought some future consumption into the present. And so we'll see slower housing growth as the recovery ages. But of course, again, that's normal, right? Housing helps get us out of a recession, but then the housing rebound slows as the recovery ages and it goes on for a longer period of time.
Peter, it's great to have you on. We were just talking earlier about the latest COVID-19 stimulus package. I think some are characterizing it more as relief, that $900 billion package. Would like to hear your thoughts on the economy, especially since we just got the latest GDP print here and the package. And how do we kind of get back to growth and your outlook for 2021?
Wow, that packs a lot. Thanks for having me. First of all, I believe in math. So if you think that the second quarter was down about 32%, and then you think, oh, wow, we're back up 34%, just to round it, we're back to near where we are. No, math doesn't work that way. You go from 100 to 68, you're back up 34%, you're at 91. We're still 9% below where we were in the first quarter. Those are amazing numbers. You look at the rate of which people have continued to be unemployed, then you look at the really small size of this relief package, how it relates to the needs for those who have lost their jobs, unemployment insurance. It's really going to be difficult. It expires in March. To think that a new administration is going to come in, depending what happens on Georgia Senate races, and even then, to be able to get something through that's really needed to help those who are less fortunate is going to be a challenge. So economic growth next year is going to continue to muddle.
Peter, that's an important point. And the question I asked you about investors, it's not being dismissive of people, millions of our fellow country folk who need help right now. But I got to ask this because millions others are seeing an opportunity to buy into this stock market. And you point out there's no alternative, but you can't think of a worse reason to increase equity exposure. And you use Tesla as an example. Can you share that with all of us, why we need to be cautious?
Well, the first thing we learn in school is you're supposed to buy low and sell high. And now we're learning that you're supposed to buy high and hopefully sell higher. If Tesla goes up half as much next year as it's gone up this year, that's 300%, it'll be more valuable than Apple. I just said a second ago, math works. I don't think that is likely. Tesla could go to zero and have very little impact on GDP. It doesn't hire that many people. It doesn't produce that many cars. So one has to put things in perspective. It's not where we've come from. It's where we're going. Where's the opportunity cost for that money?
Peter, of course, there's always opportunity in the market somewhere. Where are you finding that opportunity today?
So we think that one of the better opportunities is, unfortunately, and I say that because we're taking advantage of climate change, supply disruption, political disruption, and you're seeing that with the breakout in soybeans. What China is doing today reminds me of what Russia did in the early 70s in terms of their pre-purchases of bushels and bushels of soybeans. Those prices could be headed to all-time highs. We had 2 Category 4 or 5 hurricanes hit Central America. That's destroyed the coffee crop. We have the total mess of, if I can say that, what's going on in Brazil. And we think coffee could double from here. So next year could potentially be the year of commodities. And I also agree that the best way to reduce the use of something is to raise its price. And if we look at some of the policy changes from the Biden administration, whether that's flaring natural gas, which will then reduce fracking, that's going to potentially raise the price of crude oil in the energy sector as well. And it's kind of interesting that everybody has left, ExxonMobil in the lurch, and it's removed from indices, and it's had a tremendous rally since then.
Okay, a year of commodities, something that we'll certainly want to discuss in 2021. Peter Borish, Chief Strategist of Quad Group, I thank you so much.
Joining me now is Matt Perrone. He is Director of Research at Janus Henderson Investors. And Matt, good to see you. So you say the markets will do well next year, but they're going to look very different from the market we have this year. How so?
Yeah, that's right, Alexis. The 2020 was historically pretty narrow market. And by that, I mean very few sectors and even stocks performed quite well. And then there was the have-nots who really lagged the market. And that was really the majority of stocks were laggards. So it was quite a narrow market by historical standards. So we think that coming into 2021, given the recovery that we expect, you should expect to see that broaden out. And we will see more participation from the broader market. So look very different than last year or 2020.
What are some of the themes, the sort of the sector themes that you see in 2021? What are some areas of opportunity, maybe some overlooked areas this year, because we have had such a bifurcated year, that investors might want to look towards?
Well, in general, we would still stay with the secular winners, the long-term winners. Again, we take a long-term view. That's generally what we do. But you can tilt more towards and buy a broader basket of the stocks that really were punished or lagged because they were impacted by the coronavirus restrictions, et cetera. So, for example, an online travel, there will be travel. People will come back. I think there's pent-up demand as soon as they feel safe, whether that's in March, June, September, who knows, but they will come back. And we'll see those companies recover. Medical devices would be another sector where elective procedures have been paused. Well, those are certainly not going away, and we're going to need to catch up to those. So we'll see recovery from the sectors that were punished, but still in really good places in terms of positions within their industry to participate in the broader recovery, and hopefully for the next few years as the cycle starts anew to participate in what should be durable gains coming.
This has certainly been a challenging year for income investors because one of the worst performers of the year have been the dividend-paying stocks. Do you see that changing in any kind of a meaningful way in the early part of next year?
Yeah, well, we have our dividend index, the Janus Henderson Dividend Index, where we track dividend payouts by the 1,200 largest companies across the globe. And it has been a very challenging year, not just for the stocks, but dividends. The reason for that is dividends have been cut. In the U.S., for example, the dividends were down about 5%. We expect to come in at the end of the year. So it was no surprise that dividend-paying stocks in general were down mid-single digits or upper single digits for the year. So another sector that should benefit from the recovery would be dividend stocks. And we're seeing signs of life there. Buybacks have started to pick up again. Buybacks are up 50% quarter on quarter. And that usually is a harbinger of better times for dividends because managements feel more confident in the future. And therefore, they're raising capital return to shareholders, both through buybacks as well as through dividends. So we expect to see dividends start to increase. And you've got some Fed is going to let banks, for example, continue to make and increase their payouts in 2021. So we think it'll be a better year for dividend-paying stocks in general.
Are you concerned at all about this new strain of the virus that seems to be making its way here now from England? Are you concerned that it's going to delay the reopening trade and delay the economic recovery?
Yeah, it's certainly something to keep an eye on. It's a risk factor. And we always say that while we think the recovery is going to start to take shape early in next year and certainly get reflected more in that recovery basket I talked about, it's not going to be a straight line. We're going to see bumps along the way through either some issues with the vaccine or through perhaps another strain or mutation, et cetera. So they're going to be, 2 steps forward, 1 step back. We hope that this is, as the experts seem to think, not something at this point we need to be worried about in terms of vaccine efficacy. And if that holds to be true, then I think, as the market has generally done, is looking through that. And so far, we're cautiously optimistic this will just be a setback, hopefully, and nothing more than that.
Quickly, do you like anything outside U.S. equities right now? If somebody was looking to diversify a little bit in the new year, where else might they look?
Yeah, I think in general, the broad, as I said about the broadening market, it was really a U.S. from a regional perspective. The U.S. was the primary winner last year, and we would expect that to broaden out as well to other regions. I think most other regions will have some amount of catch up. We would favor, again, getting back to the theme of owning what you want to own for 5 years. We'd probably focus more on Asian equities as the long-term secular winners in our preferred region. But again, we will see broadening out in the other regions, in Europe in particular, over the next 12 months. That's to be expected.